welcome everybody that's here, and everybody that's out there. So everybody wave out there. Just hello. We have those iPads. If you didn't bring your own device, we have some back there that you can check out and use that. We also sent you the packet yesterday. So if you get your email, it will be on your email information there. We have a couple of things before we get started. We have 1, 2, 3, 4 presentations. All of them are great, different topics. The very first presentation will count as 1 hour of investment credit, being that it is dealing with investments and economy and what have you. So when you get your certificate, make sure you identify that as an investment credit. So it may help 1 hour here or there as you give to the auditors. Before we get started, I'm going to have David come and give you a little bit of about few minutes of overview of the bond elections that happened this month, and he has also other information regarding scholarship and other things dealing with Gulf Coast Task Force. So, David, would you come up and give us some of that information?
Very quickly, I talked to TASBO this week. Mr. Shelby and I made a road trip up there. We probably could have had our conversation on the phone, but we wanted to sit down with some of them there in the Austin office and talk face to face about the golf tournament. We put on a golf tournament every April. We're going to put one on again this April. And the purpose of the tournament is to raise funds for the TASBO Scholarship Fund. I was a little disappointed in our vendor participation this last year. We fell off pretty severely from the previous 2 years. The previous 2 years we donated a net of $20,000 to the TASBO Scholarship Fund. This last April, not so much. In fact, our participation in the tournament from those who typically over time have participated and supported that tournament was so low, we actually thought 30 days out about canceling the tournament and giving those who had actually already paid their money back. But we didn't, and we still made a decent contribution to the scholarship fund. This year, after the holidays, when we get back here in January for a meeting, I'm going to ask some of y'all to help us get the word out to some vendors. We're going to simplify the fee structure for the tournament a little bit, just to try to pull some more teams, some more vendor participation in there, and make it a little simpler for them to understand. And if y'all will help us get the word out about that, I would appreciate it. And I'll have a flyer, I'll have hard copies, and I'll have a PDF version after the holidays for you to send out to your vendors if you will do that for us. The other thing I found out about the scholarship fund is TASBO is very concerned from the standpoint that they do not get a lot of applications for undergraduate or especially for the graduate scholarships. So if you were going back to school right now to work on an undergrad or graduate degree, or if you know someone back home at your district works in a business function, business or support area, who is going back to school, let them know that this might be pretty easy money, because they only have, I think for this coming year, I think for last year we had 6 applicants. And I know we've got more people in TASBO who are going back to school pursuing degrees in that. So maybe they just forget about it. I don't know. But TASBO's biggest concern, and you wouldn't think with over 6,000 members they would have this concern, their concern is not enough people are applying for these scholarships. So basically they're saying, we've got all this money, no one wants it. If I'm going back to school, that sounds like a pretty sure thing to me. So we'll have more information on that after the holidays. Did everyone pick? Karen?
I have a quick question. Is part of the what do you think the problem was with the golf tournament? Was it that they were just, the economy had been bad for a while and hadn't recovered? Or do you think it's really timing of when it is, because you know there's a lot right now? And I wonder if that's the problem.
Yeah, we've had years where we were improving, we've had years where we peaked, and then typically in a year where we have peaked on the golf tournament on net revenue, the very next year is a fall off. It's a down year. That year was right on cycle for us to do that, and that's what happened. What contributes to that? I don't have a clue, not a solitary clue. But that is the cycle we've been doing this since 1999, and that's a very predictable cycle. So I'm hoping this year, if we stay on cycle, will be an improving year, and then 16 will be another peak year. The issue we have is with some publicity, not only locally, but from TASBO at the state level. I think we could easily double, if not triple, what we're netting for TASBO. And it inures to their benefit to help us with that. So that was the purpose of meeting with them. And then I'll talk with you again in January about maybe getting this publicized a little more locally. Because for the most part, it's going to be Houston area vendors and school business people who come out. We'll have a few that come from out of town, but it's mostly going to be the Houston area. Any other questions about that? Got a little election report outside, hard copy. Did everyone pick one up? 2 years from now, 5 years from now, 20 years from now, at or about this time, or in May, we're going to have wrapped up an election cycle for bonds, and we're going to say, wow, that was a really good election cycle. Nothing like November 2014, but it was a good one. We, as you can see from the report, an astounding percentage of the money passed. 96% in the education field, including 4 community colleges, 96% of the money passed. That's mind-boggling. What I thought would happen, and I thought it was a little optimistic, was that 70% of the elections would pass, representing 80% of the money. And that's about 5% on each side, a little optimistic compared to what November usually is. These results blew those out of the water. In an era where we have got a Tea Party movement that is gaining momentum, a Tea Party movement that is anti-tax, anti-debt, anti-local bond, to an extreme end. I'm frankly astounded at this. I think this defies explanation right now. It may take us a couple of years to figure out what the heck happened here. I'm all for it. Hey, the more you sell, the more business I might be doing. So I'm all for it. I know none of these school districts asked for money just because they thought they could. They need this. You all need this money for the different projects, the renovations, the new construction, infrastructure that's badly needed in your school district. It's the only way you have to get new money right now. So I know this was necessary, so I'm happy to see all this pass. The most notable defeat of all the elections, of course, was the city of Austin, $600 million for light rail. That pretty much went down in flames. They had previously contemplated asking for $1 billion for a number of other projects, light rail being the primary one in that group. So if the voters aren't going to vote for $600 million, they're sure not going to vote for $1 billion. And I think that issue is pretty much dead forever. And then the rest of our report, of course, is a nice little commercial with George K. Baum, and I think my handsome face is in there a couple of different times. And on the back, of course, some of you will be going to the Midwinter Conference at the end of January in Austin. Little invitation. If you plan on coming, let me me know. I presume if you're going to Austin for midwinter, you can come to our reception because it happens to be at the same time in the same place as another very popular reception that everyone goes to. So if you're going to stop by, feel free to let me know or not. Any questions about the elections other than how in the world did this happen? You've got my contact information in here. If you need anything, feel free to give me a call. Thank you, Hazel.
Thank you, David. Unpaid announcement by the firm of, just kidding. We have actually, David, 4 vendors here that might take you up on some of that form. You may want to give them a copy of that form before they leave. They have a pretty healthy balance sheet that they might think about participating. Well, anyway, on to the show. With first speaker, we appreciate his time. Garrett Sloan, a certified financial analyst with Wells Fargo Fixed Income Strategist. He was here for another presentation. He was kind enough to arrange his schedule to be here with us. Again, he's going to talk to you regarding investment strategies and what have you. So please help me welcome Garrett.
Yeah, I've got another pen. I've got books that I brought. I only brought 30, but I would like to hand them out for anybody that would like to have one or to follow along. They're mini books, so they're not full size. They're kind of fun. So everybody likes the mini book these days. So if anybody doesn't have one, I'll pass them.
They're actually pretty good. I was thumbing through those, and very nice data with fundamentals.
Oops. Oh, okay. Yeah, you don't get one. And if you want a copy of that, I can send you an electronic copy. You actually could contact Gil. At the back. Hello? Oh, nice. Okay. How's that? Is that okay? Alright. And then I'm just up here, right? Clicker? Clicker?
Oh,
Is this me?
yes. Sorry, the one, just the right one.
Okay, perfect. Okay, can you guys hear me? Okay, so this is a presentation. First of all, thanks for coming today. This is a presentation that I gave yesterday, actually, to the Texas Association of Counties. So you're getting basically kind of the same presentation. Apologies, Gil, he's heard this many times in the past. But just for a show of hands, who in the audience is involved in the kind of the day-to-day investing of your school district funds? Okay, so this, I'm going to give kind of a high-level overview of what's going on in the economy right now. And the way that I do that generally is I look at the economic situation, not necessarily just on a pure kind of economic level, but I look at it in the context of what I think that's going to do to. I feel like I'm kind of jumping in and out here, am I? How that is changing and going to impact interest rates. Because as short-term investors, I think the real key for us in our jobs and what we're trying to do with our portfolios, it's certainly important to see what's going on in the economy, but how does that really translate into kind of an investment thesis? What do we do? What do we do with our investment dollars based on what we're seeing going on in the economy? So let's just have a little bit of background here. Today was a very important day in the economy, actually. Did anybody before they came here see any of the numbers that came out this morning? We had a very, very important set of data that came out this morning from the Bureau of Labor Statistics. So we had the new unemployment rate, we had the new payrolls number come out for the month of October. So we'll talk about that in a little bit. Good grief.
You went to adjust.
Oh, did he? Okay. Okay. Hello? have to yell. I have a loud voice anyway, so I can talk through this. So the title is Maximizing Public Entity Portfolio Returns. So we're going to start off talking about monetary policy and the rates outlook. Then we're going to go through a lot of these different sections. I could go overtime every time, so cut me off. And also, I'm not going to have a Q&A at the end. I think the best way to do this, and certainly when we're in venues like this, everybody wants to know what everybody else is doing. So just this, when you have questions or if you have thoughts or if you have ideas about things that you're doing, everybody's going to want to hear what you're doing and how you're approaching issues. And I think that's one of the best things that's one of the reasons I like to come out here is to hear from you. So really feel free to comment or to ask questions throughout the presentation, anytime. So first of all, monetary policy rates outlook. So, anytime we're looking at investing cash, it's certainly important to understand the policy makers' views on the economy. Why is that? Because the short-term part of the curve, most of us are probably investing 3 years and in, maybe 5 years and in on the yield curve. That's the area of the yield curve where we see a lot of influence from policymakers, i.e. the Federal Reserve. So when the Federal Reserve is increasing and decreasing the overnight rate, that's impacting for us as short-term investors even more than the long end of the curve, directly. So it's important to understand what policymakers are thinking, and that helps us inform our investment decisions. So one of the things that I thought I would show here today is, starting back in 2013, the FOMC started asking the bank presidents, the FOMC bank presidents, so there's 12 district banks, and then there's also 7, we call them members of the board of the Federal Reserve System. So there's actually 19 members of the FOMC, the Federal Open Market Committee, that sets overnight rates, that sets the Fed funds rate. And they started asking them back in 2013 very, very specific questions. They basically asked them 2 very high-level questions. They said, when do you think it will be appropriate to start raising the Fed funds rate? And that's this chart right here. So they asked them this on a quarterly basis. So I have the June number and the September number, the result. And you can see here, so that the answer is, the question is, when do you think it'll be appropriate to start tightening policy? Meaning, when do you think it'll be appropriate to start raising interest rates? Well, you can see 2015 is kind of the consensus. So most of them really feel like next year is really the time where it'll be appropriate to start raising interest rates. The second question that they asked them is, and you can see that there's a pretty much broad consensus that 2015 is the time. There's a few outliers. The second question they asked them is, okay, well now that you've told us, when you think it'll be important to start raising rates, how much do you think we need to raise rates? And so that's translated through this chart. We call it the dot plot. Janet Yellen, in some of her speeches, she starts referring to this chart called the dot plot. Well, this is the dot plot, and I've actually taken 2 dot plots. I took the June dot plot and the September dot plot, and I compared them to see how their responses are changing over time. Well, you can see that even though most of the FOMC members think that 2015 is the time to start raising rates, you can see that a lot of them feel that by the end of 2015, interest rates could be anywhere from 25 basis points all the way up to 300 basis points, or 3%. So there's not as much consensus amongst these policymakers how much we should raise rates next year. So it could be anywhere from 0. So we've got 2 members of the policy committee currently think that we shouldn't raise rates at all. And then we've got 1 at the very top there that thinks we should raise rates upwards of 275 basis points. That's a huge, huge jump. And that's a huge dispersion between each one of these policy makers. So you can see there's not a lot of consensus, even between those that are actually making the decisions as to where the Fed funds rate should be by the end of next year. So and that's why I'm focusing on 2015. You can look at 2016, there's even more dispersion, but really 2015 is is where most of our focus is right now, because you can see here in 2014, pretty much by the end of 2014, almost every policymaker thinks that we'll still be where we're at right now in terms of short-term interest rates. Does that make sense? You following me? You know, I'm going to skip over this, but this is something, again, there's a lot of anecdotal evidence that suggests that, so again, I want to give you some context on the economy in terms of how it will affect interest rates, not necessarily in terms of the overall health of the economy. I think that, you know, based on today's numbers that we saw and everything else that we're seeing, there is a positive trajectory in all fronts of the U.S. economy. GDP growth has been coming in stronger than we expected. You know, the unemployment rate has been coming down. We're going to be talking a little bit more about the unemployment rate. Final sales are improving. Consumer confidence is improving. The housing market is improving. Is it improving fast enough the question for us as investors are all those improvements moving the dial fast enough for the interest rates to rise? My opinion is yes, but probably not as soon as some people might think. And so these are some of the comments, some of the impediments that's a lot of these. So we've got Charles Everett from the Chicago Federal Reserve Bank. Right now, here's what he says. I believe that the biggest risk we face today is prematurely engineering restrictive monetary conditions. In this scenario, the FOMC could misjudge the presence and magnitude of economic impediments and misread the recent progress we have made as evidence of sounder economic trends. So basically what he's saying is, if we're going to raise rates, we better be dang sure that the economy is on solid footing before we do that. Okay? Because raising rates prematurely and then having to backtrack is even worse than probably raising rates too late right now in this economy right now. And so it's probably important for us to understand exactly what the Fed's looking at, what we're hearing out of the Fed in terms of the things that they consider to be most important. Right now, the labor story is really kind of the whole story. So the Fed, as you probably know, has two mandates. One is maximum employment, and the other is price stability. Okay? So the price stability comes into play when we talk about inflation, deflation. Well, the inflation story right now is relatively flat. In fact, for the past number of quarters, past number of months, inflation has been well below where they would like to see it. And that's not necessarily a good thing. We want to see inflation at a certain degree because that actually stimulates spending, that stimulates business investment. And when we see inflation, really, really weak, that actually causes people to just kind of hoard cash, hold on to their money, as opposed to, spending it and going out and that's kind of where we see growth. That's going on not only in the US, where inflation is below target, but that's going on in Europe. Europe is a mess when it comes to inflation. They're actually below 1%. They're close to deflation in a lot of the economies there. And that is a serious concern. And that's why we've heard recently from foreign central banks. So a lot of us in our heads, we think, well, the Federal Reserve is the only bank that we care about. We only care about what they're doing. Well, the ECB is a very important central bank. Guess what? They buy agencies, they buy treasuries, they buy a lot of the same securities that you buy. And the Bank of Japan is another one that buys a lot of the same securities that you buy. We recently heard a couple weeks ago from the Bank of Japan that they're embarking on a quantitative easing-like program similar to the Federal Reserve, and similar in magnitude, meaning that they're going to be spending tens of billions of dollars a month on buying securities. Well, what does that do? That actually puts a lot of downward pressure on yields on a lot of the same securities that you're buying now. So even though we're seeing at the beginning of the month, or at the sort of mid-month, we heard the Fed say that they're going to basically halt their quantitative easing program, meaning that they're going to halt buying all their mortgage-backed securities, treasuries. The market sold off a little bit, but immediately when they heard that the Bank of Japan and that the ECB were considering, buying securities to stimulate their economies, the market rallied again, especially the treasury market, the agency market, the stock market, all those markets rallied because these huge investors influence our economy and influence our markets here. So as short-term investors, it's kind of important to have our finger on the pulse of what other big investors around the world are doing as well. So the Federal Reserve, again, like I said, is a big investor, but they're also our policymaker, so it's important to understand what exactly is important to them. Labor markets is really what's important to them. And we have seen labor markets improve. There's no question. We're seeing the unemployment rate come down. In fact, the unemployment rate today was 5.8%. That's a really good number. And on a headline basis, so we call the 5.8%, that's actually the headline unemployment number. And historically, nobody's really kind of moved past, that's something in my eye, sorry. Nobody's really moved past the headline unemployment number because there hasn't been a lot of need for that. But there's a lot of other things going on in the labor markets right now that would suggest that the headline unemployment number is not telling the full story. So this is a chart that shows in the blue, we've got the headline unemployment number showing right around 5%. And then we've got 3 other unemployment metrics built in there. We've got a section in there called discouraged workers. That's the level right above the blue. Those are all people that have basically said, you know what, I'm not even looking for a job. Forget it, there's no jobs out there for me. We call those discouraged workers. They're available for work, but they're just not looking anymore. So we don't actually even count them as part of the labor force in the headline unemployment number. Well, guess what? Those people still exist. They didn't all fall off a cliff. They're still out there. We've got another group called the marginally attached to the workforce. So those are people that have needed to kind of step back from the workforce for various reasons, i.e. maybe potentially going back to school, they might have family-related issues. They're marginally attached to the workforce. And then we've got this other group, you can see this brown group, they call them part-time for economic reasons. This is a very large group, and this is something we've actually heard specifically addressed by a lot of policymakers, that there are people that are working part-time but that would like full-time jobs. So we call this, so if we add all those up, we call that the U6 number. It's the U6 unemployment number, and it's sometimes termed the underemployment number. Okay, so underemployment. That's a big issue. And there's always been you can see there's always been a spread between the headline number and the headline number and the underemployment number, but that gap between the two has widened since the financial crisis. And so there is a large number of people that never used to exist in that underemployment category that now exist in that underemployment category. Those are the people I think that when the Fed's looking at the unemployment rate, this is another group that they're saying, well, yeah, the unemployment rate looks good, but it's not capturing everything. And this is another way of looking at it. So we look at the labor force participation rate. So you can see the correlation. So the top line there is the unemployment rate, okay? And the bottom line is the brown line is the participation rate, the blue line is the headline unemployment rate. And you can see how the unemployment rate has come down, but guess what? Look, right at the same time as the unemployment rate coming down, the labor force participation rate has come down significantly. So from there, you can see how much that's steepened. Now there is some demographic trends that have been going on. The labor force participation rate has been coming down since the early 2000s. There's obviously an aging population, but even if we adjust to just include the population that's 20 to 45, kind of the meat of the workforce there, that labor force participation rate has been coming down as well, and has certainly been coming down much steeper since the financial crisis. So a lot of this, some if not all of the, not all. I know that there's some positive things that we're seeing as well. But some of the decrease in the unemployment rate has been directly a function of people just backing out of that market. And so that's why we look at the U6 number, the underemployment rate, as well as the headline rate. Again, in terms of informing our position on how quickly the Federal Reserve will raise interest rates. This is something that's very interesting, that the Federal Reserve Bank of Boston did this study, and they looked at historically how far away was the current unemployment rate from the average unemployment rate historically when the Fed started raising interest rates. Well, on a headline basis, they looked at the Federal Reserve Bank of Boston looked the last time they raised rates, and that was right here. Well, this flat line is the average, and this is where the unemployment rate was at the time. So we were only, when they raised rates last time, they were about 0.12% off from the average. Right now, we're about 0.82% off from the average, so we're a little bit further away on the headline number from where we were when we raised rates last time. But if we look at the underemployment rate again, so last time we were about 0.06 percentage points away from the long-term underemployment average. So we were relatively close to that underemployment number. Right now, we've got a huge gap between where the average was, and this is the pre-recession average, by the way, so this doesn't take into account what we saw, how the underemployment rate spiked. So we've got a lot of room to make up there. He was making the argument with this chart that, you know, he was trying to basically say that, you know, low interest rates make a lot of sense because we still have a lot of room to grow in the labor markets. On the inflation side, I just really want to briefly touch on this. A lot of people ask me, certainly, you know, why, if the Federal Reserve is printing money, and they are, trillions of dollars, why isn't there more inflation? Well, on the one hand, I would probably say that there is a lot of inflation in the sense that if they wouldn't have printed any money, we could have seen every asset class out there crash. You know, we would have probably seen the stock market crash much worse. We would have seen home values crash much worse. So a lot of the liquidity, a lot of the money that the Fed's printing and putting into the system has gone to support these types of asset prices. But why isn't there more inflation? Why aren't we seeing inflation at least above target, the 2% target? Well, the reason is because a lot of that cash that the Fed has been printing, just over $2.7 trillion, is sitting in terms of excess reserves on bank balance sheets. So if you pulled down the 10K or 10Qs of the 10 largest banks in the US, you would see them sitting on hundreds of billions of dollars in cash. Cash, just not doing anything. Earning 25 basis points. So all this money, the Fed is paying 25 basis points on all this cash, and it's being paid to the large banks, just sitting on bank balance sheets and not doing anything. It's not circulating through the system. So it's not making loans, and it's not, you know, it's not traveling around, it's not building the economy, it's just sitting there. And we can kind of debate why that is. Certainly demand for loans from the business sector is extremely low because they have a lot, you know, there's certainly fears around, you know, whether or not they can sell their goods. So are they going to expand their businesses until they have some certainty around whether or not there's a consumer there for their goods? No, they're not. They're actually deleveraging. Most people are still deleveraging their balance sheets, meaning reducing their debt as opposed to increasing their debt. So that's one reason, but there's obviously a number of regulatory issues around banks and their balance sheets, and they're wanting to certainly sit on a large amount of liquidity. We've got a very, very big piece of legislation, Basel III, a part of Basel III. Anybody heard of that, Basel III? The big international regulatory kind of unifying regulation. There's a big part of Basel III that's going to be coming down on US banks at the beginning of next year. It's called the liquidity coverage ratio. So that's forcing a lot of banks to have to hold on to a lot more liquidity, a lot more high quality assets, just to hold on to your deposits. So if you have deposits at banks, there's a much higher stringent threshold that banks are going to have to meet in terms of the assets that they hold on their balance sheet just to offset the deposits that you make at those banks. And that's coming online at the beginning of January of next year. Now that is the liquidity coverage ratio the reason why banks are sitting on $2.7 trillion? Probably not, but I think that's maybe a little bit of it. This is kind of a fun slide, but I'm not going to go through it. Really, again, actually I will go through it, just very briefly though. So we talked about the things that the Fed's looking at, but if you also go back and look at each one of the Fed presidents and Federal Reserve Board of Governors members, they all have kind of a different take. You remember that dot plot chart? Every one of them looks at the same data and they look at it slightly differently. So not every single member of the FOMC is a voting member every year. They rotate every year. So next year, and so what I did is I basically looked at 2015 and I said, well, if I look at their voting records and I look at kind of the comments I see that they're making about the economy, what are they most concerned with? And then you can kind of extrapolate. Again, this is not hard science here, but you can kind of extrapolate what they might, on what side of the coin they might, flip as to whether or not they want to raise interest rates sooner or later. You look at 2015 as a time frame. The voters here are largely, we would call them more dovish, as opposed to more hawkish. The hawks are much more concerned generally with inflation. The doves are more concerned with the labor, so we have that dual mandate again. We have some that are thinking more about the labor market, some that are thinking more about the inflation situation. Next year, the actual people that get to vote are largely more dovish in nature. Again, not necessarily this isn't hard science, this is just kind of my opinion. But that would lean them, if there's any sort of blips in the economy, might lean them to holding off on interest rates for a little bit longer. One final thing here on this, there's definitely a trend from the policymakers to look back at previous recessions, and the recession that probably is closest to what we saw in the 2008, 2009, 2010 timeframe is the Great Depression, okay? And Ben Bernanke actually wrote a piece back in the day. I think I pulled this data from his data set, actually. And one of the things that he looked at, and one of the things that I'm pointing out here, is this is the 3-month T-bill rate, okay, during the Great Depression. So it goes from 1928 up to 1941. You can see right here, there's kind of a blip here in short-term rates. Short-term rates started to creep higher, and as a result, these brown bars, we went immediately back into recession. Now, I'm not saying that there's perfect correlation here, because we obviously saw rates, spike up and then come back down. But we saw rates here go up, and immediately after rates went up, the economy went back into recession. And that kind of goes back to the whole idea of the economy needs to be on a very, sound footing before we see interest rates rise. Well, this is right now. This is where we're at on the right-hand side. The 3-month bill has been flatlining for a number of years. So the question, really, I think that a lot of us have, is if interest rates rise significantly, can the economy withstand it? And I don't think I have the answer for that, and I don't think that the Federal Reserve has the answer for that, but I think that they're thinking about the potential impact that rising interest rates could have, and they use the Great Depression as one example. Does that make sense? Okay. Flipping away from policymakers and looking towards the markets, short-term cash markets remain extremely compressed. So this is a chart of 3-month LIBOR and 3-month T-bills. The difference between LIBOR, so LIBOR is the rate at which banks will borrow and lend to one another we call it the interbank market. So that banks have a need for cash, and some of them have excess cash. They'll lend cash on an overnight basis or on a term basis to one another. LIBOR is one specific market that buying and selling is going on in. The Fed funds market is another market where that buying and selling is going on. The difference between LIBOR and the T-bill rate we often refer to as a kind of a credit risk assessment. So if banks are very fearful of what's going on in the market at the time, they will charge a much higher rate to lend their cash. And you can see during 2008, this was during the Lehman crisis. So LIBOR absolutely went through the roof, and I promise you that there were no banks even lending at those rates. No banks were lending there. They just basically said, okay, well, we'll put it at 5%, but there was no trading going on. And at the same time, you can see the T-bill rate fell through the floor right then. So everybody was moving into T-bills, nobody wanted to lend to each other. The reason that the LIBOR rate came down so quickly like that is because the Federal Reserve started printing cash, and everybody was becoming more comfortable with their own liquidity situation. And that's continued on because, like I said, the Fed has printed so much money. There's not a lot of credit risk. We're not seeing a lot of fear amongst banks for buying and selling of cash. One final thing here before we move on to the next section. This is again, so I gave you sort of a definition of what LIBOR is. It's that buying and selling of cash for terms between banks. And a lot of you might use LIBOR if you're buying floaters. A lot of them are based off of LIBOR. So this green line here along the bottom is the current LIBOR, 3-month LIBOR rate. Okay, it's actually on the left-hand side here. So 3-month LIBOR right now is around 23 basis points. This blue line, there's traders in the market that actually will trade based on where they think LIBOR will be at a future date. So this blue line is where traders believe that LIBOR will be in December 2014. And this brown line is where traders believe that 3-month LIBOR will be in December 2015. And you can see mid-October, now that's come back since then. This chart needs to be updated. It's right around 80 basis points now. But mid-October, when the Federal Reserve stopped their quantitative easing program, when they announced it, when we saw a lot of scare around the Ebola outbreak that was going on, a lot of scare around global stock markets, we saw some weakness out of Europe. There was a lot of things that kind of coincided, and the expectation for markets was that interest rates were not going to rise. So late September, they thought that 3-month LIBOR by the end of December would be around 110. That fell all the way to 65 basis points. So that basically, the market almost removed 2 Fed tightenings out of their expectations for short-term interest rates, just mid-month of October. That's come back, but right now in the market, there's a little bit of expectation that the Fed will probably hold for a little bit longer at the current rates that they're at, and might be sort of the latter half of 2015 as opposed to mid-2015. Positioning on the curve. So I want to walk you through this a little bit. So we've been talking about expectations and rising rates. Well, a lot of us are very fearful of a sharp correction in rising rates, because that obviously impacts our portfolios on a mark-to-market basis. So if we have to calculate the market value of our portfolio, if interest rates rise significantly, then we could show a total, we might show a loss. So because of that, some of us just decide to sit in cash. We don't do anything. We'll just sit in cash. Well, there's an opportunity cost for sitting in cash, and I want to kind of walk you through some numbers here. I call this the cost of waiting. And when we sit in cash and we don't do anything with our investments, we're expressing a market view. So if you're sitting in cash, and right now the cash rate we're going to call it 3 basis points. It's actually a little bit lower than that. So if we looked at 1-month T-bills right now, so if you're considering the cash rate of 1-month T-bills, it's around 1 basis point. We'll call it 3. So if you have a $3 million portfolio and you're sitting in cash earning 3 basis points, and let's say an alternative might be buying the 3-year treasury, or we could say the agency, but I'm just using the treasury. Use the 3-year treasury at 95 basis points. And if our investment horizon is 3 years, let's say I sit in cash for the next 6 months. And over those 6 months, I've basically, of my 3-year horizon, I have about 2.5 years left after that 6 months has passed. During that 6-month period of time, I've foregone on a $3 million investment about $13,800 in income. Because a lot of us, I certainly know that most of us are income related. We're not primarily active investors. We're buying hold to maturity investors. We're not trying to time the market. So we're income investors. So income is important to us. So $13,800 we've foregone by sitting in cash. And if I wanted to break even, so if I would have bought the 3-year at the outset, and I wanted to break even with that 3-year, the 2.5 year, I now have 2.5 years left to invest. I would need to invest for 2.5 years at about a 113 interest rate to break even had I invested just at 95 basis points. So that's telling me that I would need to see the 2.5 year rate move up to about 113. Well, right now the 2-year is right around 50 basis points. The 2.5 years, between 60 and 70 basis points. Now, is it possible that in 6 months the 2.5 year rate could be 113? It's very possible. But that is kind of, when you're sitting in cash, that is kind of the calculation that you're making. We might not realize that that's the calculation we're making in our heads, but that is what we're saying when we're thinking about our portfolios. There's a cost to sitting in cash, and that cost is borne out in foregone income that we could potentially need or want to make up. Now, I know that all of us aren't being driven for yield. I mean, we have the safety, liquidity, and then yield as a third criteria. But there are opportunities for us to generate excess yield. There's a lot of ways we can think about $13,800 in this context. We can think about it in terms of what else could that money, if I were able to generate that income, what could that be going to in my school district? And that's a $3 million investment. And I hope that makes sense. And I'm not trying to drive anybody into any specific, investment thesis or alternative. I just want people to sort of have that understanding of when I'm sitting in cash, or when I'm sitting on too much cash, or when I've been sitting in cash for the past 2 years and I've just been sitting on this pile of cash and I've really not done anything with it. There is a cost to that, and it's not necessarily in a loss, but it's sort of we call it an opportunity cost that we could have been earning investment dollars. This next slide is basically the same analysis. Goes through a 6-month holding period, goes through a 12-month holding period, 18 and 24 months, and it compares it to a 5-year investment. It's definitely something that's very interesting when the cash rates that we're earning right now are so low. Now, I know that some of you on your bank deposits are earning well above 3 basis points. So I get that. But I'm using actual true market rates. The question is really whether or not those bank rates will exist, forever. I would say that in the new regulatory environment, the real theme that I'm seeing from a bank depository standpoint is more downward pressure on rates as opposed to, bidding up for assets. That's certainly happening at the larger banks, and I think that's probably going to trickle through to almost all banks, because the cost for banks of especially collateralized public entity deposits is becoming extremely expensive for banks to do that business. And so I think that I do think that deposit rates that banks are paying will converge much more closely with true short-term rates that we're seeing in the market. Now, will they cross over? Probably not, but I think they're going to get closer. Looking at points along the curve. So we talked about the cost of waiting. So those of us that are sitting in cash, there's obviously a cost to sitting in cash. We're making a market view when we sit in cash. So where are we getting paid if we go out along the yield curve? So am I going to buy a 2-year or 3-year security if I'm not getting paid for taking on that risk? Because there is risk for moving further out the curve. So this is a slide that basically shows how much I'm getting paid at different points along the curve. So we call this the roll down, okay? I don't know if any of you have heard that term, the roll down. But if you buy a 3-year security, you hold it for the next year, well now it's a 2-year security. So it's rolled from a 3-year down to a 2-year. And generally the difference in interest rates between a 3-year and a 2-year it goes down. So we call that the roll down effect. And depending on the steepness of that roll down might influence the relative attractiveness of that security. So the roll down, I compare a couple of different points along the curve here, the 1 month versus the 3 month. And the brown lines here are the 5-year historical average of that roll down between 1s and 3s, 1 month and 3 month T-bills, 3 month and 6 month T-bills, 6 month and 2-year notes, 2-year and 3-year notes, and 3-year and 5-year notes. So you can see in the 1-month area, there's basically no incentive for an investor to go out to 3 months from 1 month. Because historically, you get about 1.5 basis points of additional yield for moving from the 1 month to the 3 month bill. And now you're getting 0. Similarly, the 3 to the 6 month, historically you get 4.5 basis points roughly, now you're getting 3. So it's a lot, the curve there is flatter, we would say. 6 months to 2 years. This is where we start to get a little bit interesting. So historically, the pickup has been around 32 basis points. Right now, it's around 39. It's not extreme, but relative to the historical average, it's steeper than the historical average. Then this 2 to 3 year part of the curve, this is where it gets, I think, more interesting. Historically, it's around 30 basis points. Now it's around 45. And some of the things that we've been seeing recently in the market, the 3 to 5 year part of the steepness of the curve, it's been kind of floating around its historical average. So you're not getting paid extra, but you're not really suffering. It's not flat, it's not steep, it's just kind of what it is. So this kind of gives you some perspective as to whether or not you're getting paid for taking on a little bit of incremental, we call it duration risk. Another way of looking at is how much additional return am I getting for moving out to different parts of the curve? And we're saying incremental yield per month. So I'm going out, if I buy the 3 year versus the 2 year, I'm going out an additional 12 months. Well, how much extra yield am I getting per month if I go out to the 3 year part of the curve versus the 2 year? And you can see here in this little analysis, again, this isn't robust. I haven't done any statistical analysis on this. I've just taken the different points along the curve, and sort of strip the yields out by month and said, this is how much I'm getting paid per month for buying, each one of these maturities. You can see that 2 to 3 year part of the curve, again, is the sweet spot. The 1 year part of the curve is extremely expensive right now, especially in treasuries. Now, if you're agency buyers, the 1 year, 2 year part of the curve is actually very attractive right now. So if you're an agency buyer, this analysis doesn't hold. For treasuries, it's very expensive to buy treasuries in the 6 month to 1 year part of the curve right now. I'm going to skip through that, and I'm going to go through, am I going to go through this? Is there anything that anybody wants to talk about so far? Have I skipped over anything that anybody has questions about or thoughts about or wants to contradict or tell me I'm an idiot? So there's a couple of ways we can go. I can keep talking about, I think I've got we got about 10 minutes. So I can keep kind of going. I wanted to kind of cover a little bit about the supply situation in the market. So the reason that I want to talk about the supply situation is, as a school district, you're obviously governed by the Texas Public Funds Investment Act. Now, do all of you have individual investment policies as well, above and beyond just using the statute? Do most of your investment policies just basically follow the statute, or do you have more restrictive guidelines, or more restrictive for the most part?
A little bit of both.
A little bit of both? Now, you can't be obviously less restrictive than the statute.
No.
But
some mirror the statute.
Okay. Well, for some of you that are maybe more restrictive than the statute, I would probably say that, if I were to guess, you're probably more restrictive on your maturities. You're probably more restrictive on your products, and you probably aren't. If you're more restrictive, you're probably stripping out things like commercial paper and anything that's got credit related, any sort of credit risk in it. What I would say is that the supply situation in the market right now is such that I feel like it's probably an important discussion to have about making your investment policy a little bit more flexible. Because one of the things we're certainly seeing in the market right now is a lack of supply in a lot of products that us as public entity investors buy. So if you look here at the debt trends, the issuance trends in the US bond market, you can see the trend is really in favor of things like corporate debt and mortgage-backed debt. Now, I know obviously that mortgage-backed debt is completely off the table, but corporate debt in the form of commercial paper is something that I think a lot of you might be able to consider. as an alternative asset class, and I'm gonna bring that up in a little bit here, but you can see that the biggest issuers in the market right now have become corporations. That's the kind of goldenrod bar there. You can see how much that's started to heat up. Treasuries and mortgages. And you can see that the agencies are making up a much smaller and smaller proportion of the overall US bond market. And that's going to continue. And the reason that's going to continue is, well, one of the reasons is that Fannie and Freddie are in conservatorship, and they've been asked to continue to reduce the amount of securities that they hold. Well, one of the reasons that Fannie and Freddie became these gigantic, issuers of agency debt was because on the other side, they were buying and owning mortgages. So they had two businesses. They were mortgage guarantors, but they were also mortgage owners. So they would go out in the market and just buy mortgages to sit on their own balance sheets. Then they would sell agencies to us to finance those purchases. Well, they used to be trillion plus owners of mortgages. This is the chart that shows basically the trend of how they are going to have to continue to reduce their, we call it the retained portfolio mortgages. They have to continue reducing those retained portfolios. Well, if they're not holding as much in mortgage-backed securities, they're not going to be issuing as much debt, and we continue to see that is the situation.
Does that mean less credit availability for potential buyers?
Less credit availability? Oh, in terms of, well, so, that's sort of a bit of a different situation. So, obviously, we still don't have any legislation from Washington as to what Fannie and Freddie are going to look like, but their guarantee business is going to continue. The issue there is just that they will not be able to own those securities anymore. So they haven't had any sort of mandate to wind down any of their guarantees. And that's, I think, basically where we're going to see the changes with Fannie and Freddie going forward, is how that guarantee business will evolve. Certainly, as owners of mortgage-backed securities, they will not be the largest owners of mortgage-backed securities in the market anymore. So does that have an indirect impact? If there are other investors that don't come in and purchase those securities, that will drive up certainly yields on mortgage-backed securities, which then translates into higher mortgage rates for us. So there is an indirect impact there for them kind of getting out of that market. The question is whether or not private investors will be able to step in and take their shoes and fit into their shoes. Does that help? Okay. From a cross-sector relative value basis, this is a really interesting slide. So if you go back the past 10 years, this is slide, I think that your books are slightly different than my presentation. I'm using, I couldn't actually download the same presentation that you're using because something was wrong with my computer. So it's roughly the same presentation, but I think that you have a few additional slides in yours that I'm not using today. 35. So this is slide 35. Okay, great. Okay, I took out a lot of slides on this presentation. Oh, did I? Okay. Well, those slides that are in your books really are going through, I think, in more detail the supply situation. They talk much more about what we're seeing with Fannie and Freddie and home loan. So if those of you, I don't know if any of you are able to buy all the agencies, Fannie, Freddie, home loan. What about the Supras? Are you allowed to buy supranationals here? So when I say supranationals, World Bank, Inter-American Development Bank, and those types of issuers. That's something, I know that I'm pretty sure that that's not in the statute. There's different states. I was just in California this week, and one of the things that the state of California just passed was the explicit ability to buy supranational issuers. From a credit risk standpoint, it's certainly something that I think that all states should consider. And I think that for those of you that, as we see this, and my slides kind of illustrate that the supply situation is getting worse. We're seeing less agency issuance. We're probably going to see less treasury issuance. We're seeing more corporate issuance. Anytime you can add an extremely sound an issuer like the World Bank or other issuers like that, gosh, I mean, I think it certainly warrants a conversation with lawmakers, and hopefully that's something that happens here, because they are very, very strong issuers. They didn't get downgraded with the U.S. government, even though the U.S. government is, was downgraded by S&P to AA+. The World Bank did not get downgraded, so they're still AAA. So I'm a big advocate of those. Anyway, so if we move on to slide in yearbook 35 here, annual returns for short duration sectors. So basically what I did here is I overlaid the Fed funds rate. So that red line is basically showing how the Fed funds rate changed. And then we can kind of look at the different sectors and how they performed in different regimes, different interest rate regimes. And you can see that, and again, I know that, the Texas Public Funds Investment Act is restrictive, but, being able to add, at least the ability to buy commercial paper. Municipals, you can buy municipals in Texas, right? Yeah. I think that that's another asset class that makes some sense, obviously more sense for taxable buyers, but even for tax-exempt buyers. In some parts of the yield curve right now, it makes sense to look at the muni sector. Actually, in these, you can see in the 2011 and 2013, these are on an after-tax basis, so these are even for those that don't get the tax advantage. The muni sector in 2011 and 2013 really performed very well. And this is actually the same analysis just for rising rate environments. So I looked back at the rate hikes in 94 to 96, the rate hikes in 99 to 2001. So just wanted to show you which sectors were performing the best during rising rate environments. Do you have that in your book? Slide 20, slide 36. Gosh, now I'm all paranoid that we're not on the same page. Short-term rates, so government cross-sector relative value. For those of us, again, that are income kind of generating buyers as opposed to total return buyers, for those of you that are total return buyers, I generally don't recommend callable securities, but for those of us that are income-focused investors, I do think that there's value in callable securities. And right here in this sector, in this analysis here, we look at all sectors that are government-related, which are most of the securities that you can buy, that are attractive, and certainly the callable sector, as well as the brokered CD sectors. Brokered CDs, you can buy those here. Brokered CDs, probably, for smaller investors, for those that are investing kind of, 50 million and below, there's not as much liquidity in a brokered CD program. But in terms of just outright yield for a government-protected FDIC-insured product, gosh, there really isn't anything else that even comes close to it, to be honest. The problem, I think, for a lot of investors is there's a lot of line items to deal with. You have to buy in $250,000 increments. So there's somewhat of a headache there, and then a lot of times you might already be filled to that specific name. But just if you're looking on a pure relative value basis, the two sectors that I find to be most attractive for income-related investors certainly are the brokered CDs and the agency callable sectors inside of 5 years.
Gary,
Yes.
Recently, met with Gil a couple of times, and when I showed him a CD that was yielding 2%, a broker CD similar
Yeah.
environment.
Yeah.
And how are they able to do that? Or if you know.
Well, what was the maturity?
30 days?
30 days.
Rolling every 30 days.
Oh, okay. So, how can they do that? Well, there's definitely some. There are definitely some issuers that are more, I don't want to say desperate for funding than others. I mean, when you have the backing of the FDIC, I think that there's obviously, you kind of take the credit risk equation off the table. But for someone that's looking for 30-day money at 2%, there's obviously issues there, right? Because that is so above market. So it's clearly, from my perspective, that would probably be someone, an extremely small financial institution is very desperate for funding, that is willing to basically pay whatever it takes to get their money. 2% would be certainly well above, and you can see my curve here. This curve is taken from market rates from some of the largest issuers out there in the brokered CD space. For 30 days, there really isn't anything that comes close to that. But I mean, if that's something that's out there, again, you know, you're taking the credit risk off the table when you have the FDIC backing of that security. So that is attractive. Now, if it's a 30-day, I guess I'd have to look at the structure of the investment, because when you say it's a rolling 30-day, I guess the question is whether or not they're actually building constructing an actual ladder portfolio for you and actually investing your money in longer dated securities, and there's only money coming off every 30 days. I guess I would have to, your full balance would be available every 30 days. Yeah, so that's a very attractive program. And I don't have that on here.
Well, I haven't seen it before, except that I ran into it, so.
Yeah, well, I'd be interested in talking to you a little bit more about that. From munis versus corporates, you know, I don't think that I probably need to sell this story to you. I think that basically this is the story that really goes towards the corporate buyers that have, I gotta be done. You know what? Trends in corporate portfolios. The thing that I wanted to show you, let me just wrap it up right now. Are you sure? I mean, I always go overtime, so I don't care if you stop.
But we'll just adjust the schedule as.
The one thing that I wanted to show you is that there is a trend in corporate portfolios. That trend, actually, hang on, let me back up here. The trend in corporate portfolio, that's probably self-explanatory. You know what? I'm not going to go overtime. I'm gonna keep it here. Slides, munis versus corporates. I think this is when I talk to investors that are already buying things like commercial paper. You know, you see the headline risk out of a lot of municipalities, and I feel like that risk is, for the most part, overplayed. I do like the municipal sector on a credit risk basis, and this is a table that really explains that. And a municipal security, my point is that a municipal security that is rated AAA, AA, single A is not the same as a corporate security that is rated AAA, AA, single A. This is probably music to your ears, right? Probably like to hear this as municipal issuers. And it is true. And the history of muni defaults and corporate defaults really plays that out. And that is really what this chart shows. Is, you know, if you look at the history of corporate defaults, you can see even at the AAA sector, historically there's been a 1.09% default rate over the 1981 to the 2010 period. You have to go all the way down to the BB sector, which is what I highlighted in red, for the equivalent or to exceed that 1.09% default history at the AAA sector in the muni sector. So this is a very, very effective presentation, I think, when I talk to clients that are already buying corporates that are considering municipals. And I'm not sure what the Texas Public Fund Investment Act says in terms of municipality ratings that you can buy. AA. You know, I think that there is value. I think right now, in terms of the muni sector, there's the most value in the single A sector of the muni. If we were kind of like looking at the yields in the AAAs, AAs, single A's, there's a lot of value in the single A's. And again, if we look at this, you know, the historical defaults, even at the single A level in the muni sector, are very, very reasonable. And so buying double A's, are there any double A buyers of munis in here? People buy munis? Yeah, some. It's just from a risk-reward standpoint, I think it makes a lot of sense to not really just kind of dip in the AAA sector, especially for those of us that aren't getting the tax treatment, but moving down the credit curve in the muni sector, I think is very attractive. You know what, I'm going to wrap it up there. I think everybody's got the books. If you don't have a book, certainly you can reach out to Gil.
Or Jesus.
What's that?
Jesus or
Oh, okay, reach out to Jesus or to Gil. And if you want to get a copy of it, and if you didn't get it, basically the rest of the presentation is talking about trends in corporate portfolios, which I do think applies to public entity portfolios and how they're investing. And then a discussion about money market fund reform, I believe, is how I wrap that up. So is there any questions? If not, we'll leave it at that. Thanks for your time.
All right, so good morning, everyone. Thanks for, I'll catch you back up to 45 minutes or less, hopefully, so we can keep this on track. Yes, I am. I'm originally from El Paso, Texas, but I lived in Laredo a long time, and I went to high school there, and obviously high school years for me was better years. And then I went to college. But anyways, so we're going to talk about retirement. Obviously, I did not come up with that title. You know, I think it's from school business to Sandy Beaches. It was not my original title, but we are going to talk about a lot of details of retirement. We're going to go ahead and cover the very basics, which is why you have that brochure in front of you. AXA is a financial services company. Within AXA, there's a group called the Retirement Benefits Group. That group specializes in working with the K through 12 and nonprofit institutions. That's why we have brochures and a lot of material which is geared towards educators and towards nonprofit institutions. Therefore, that's why you have that brochure in front of you. AXA approved that one about 2 years ago because of a lot of the business that we do with school systems and school districts around the nation. There's a couple of key points. I am not a representative from TRS because I am going to be talking a lot of information on TRS and how the pension works. So just to be clear, I do not represent TRS. And I am licensed to give advice, basically Series 7, since it's all that good stuff. We do not give tax, all that disclosure you can do. All right, so we're going to start with the very basic. We're going to focus on TRS, which you're already paying into it, so might as well understand how that works. Especially because of over the last couple of years, there's been many changes. For some of you that have 15, 20 years, you remember the big change in 2005. That's the first time they ever separated the two types of members. You had grandfather members, and then you have non-grandfather members. Well, fast forward to today, you have 4 different members, and they call it into 6 different tiers if you log into the TRS website. So this is just an assumption or a case study to kind of play with some numbers here. This presentation was given back in January, so a lot of that information was reflect like May of 2014. But if you work in the school system and you're in the school, for the most part, your retirement date will be May 31st of that particular year for a lot of reasons, as far as getting an extra paycheck from TRS during the months. If you're an administrator, depending on your district, you may have a different contract that forces you to stay all the way up to August. So there's a layer variation here. In this case, we are using member age at retirement, 62. That 62 was picked because the last tier of TRS members, that's one of their requirements. They have to have 80 points, plus they also have to be age 62. So in this case, we're looking at a grandfather member. Can someone tell me how can we determine that that's an individual that's a grandfather member? The average of the top 3 years, right? So if you're unsure of what category you fall under, the more important thing is to identify if you're a grandfather member. So when you read the statement, it will literally say there, grandfather member, or you just look at the formula on the second page and it'll tell you the average of the top 3. If it gives you the average of the top 3, you're a grandfather member. Everyone else is the average of the top 5. So this is pretty much how the formula is calculated, right? This individual is 62. The average of the top 3 salaries, 65,000. The formula for how much you will get to get the standard annuity would be years of service times 2.3% times the average of your top 3 salaries. Your top 3 salaries are usually your last 5, but that's not always the case depending on the types of positions that you've held in the school district. So therefore, we go over all those numbers and then you get hit with the standard annuity. So the standard annuity is the amount that you're going to get without counting any deductions, right? If you order your retirement packet, or we'll call it the blue packet, or look at the numbers, you know that after that amount, there's a lot of options, a lot of deductions that you can select from. So these is just to mention a couple of them, right? This slide is very busy. It's a lot of things going on. So we're just going to go ahead and focus on the first option, right, which we look at the standard annuity payment is $3,700. That's if you retire and you pick no benefits. Right from that payment, you still have to subtract taxes and health insurance costs, which is another big change that I'm going to go ahead and mention here in a little bit. But you'll get the standard annuity, and if you select no options, you'll go ahead and deduct the taxes and the health insurance costs. And then whatever is left is what you get to take home, or what gets direct deposit every first of the month once you retire. You have the 5 options. They're called survivorship options. The reason why is because they're an option that, in option 1, and a lot of that information is in the packet as well, is if I pass away and I retire from TRS, then I'm going to go ahead and bring my standard annuity down to option 1. So instead of getting $3,700, I'm going to get $3,300. But what that does is it allows me to go to sleep at night. Why? Because if I pass away, my spouse would get 100% of that amount. Right? So option 1 is 100%. Option 2 is 50%. Option 3 and 4 are very tricky because they're period certain that you'll read that information on the brochure. It just pays you for 5 years after retirement, or option 4, it pays you for 10 years after retirement. Okay, and I'll tell you in a little bit why that's not necessarily a good deal. Hence, that's why it costs less. And then option 5 is 75%. That means that if I pass away, my spouse will get 75% of that $3,400. So the difference between the standard annuity and the different options is what it's going to cost you to select those options. Now, it's very important that if you're getting close to it, or you're about to make a decision, or you know someone that's about to make that decision, you understand that, because once you make those options, it's not like you can go back. You know, I made the option 2 years ago, and I can go back and change it because I changed my mind. So that payment is going to be for the rest of your life. Then we're going to go ahead and make it more complicated, and we're going to add the partial lump sum option, right? One of the major changes in TRS was grandfathered individuals can get the partial lump sum options whenever they get to 80 points. Everyone else has to go to that 90 point. Why am I clarifying this? Because whenever I go and meet with someone, they get confused and they think that they have to work till they achieve 90 points to retire. Well, some individuals can still retire at 80 points, but they won't have access to this right here, which is a partial lump sum option. A partial lump sum option is 12 months, 24 months, or 36 months worth of TRS payment in advance. Now, you see the numbers here, and now you see how much more that's going to cost, right? So if you retire and you want to give 100% of your benefit to your spouse if you pass away, and you want to get the 36-month partial lump sum option, you're going from $3,700 to $2,600 a month permanently. Now, granted, you're going to have $134,000 that's going to be rolled over to you, but that $2,600 is going to be for the rest of your life. One of the key things to understand from TRS is TRS does not necessarily have a true cost of living allowance, okay? Which means that's huge. It might not be big when you first retire, but you know, they were talking about inflation and the numbers that the government gives us and all that. The fact of the matter is that our inflation is a lot higher than what the numbers project, right? Because when you go to HEB, you know, you can't walk out of there without spending $150 to whatever the amount is, and I guarantee you next year when you do the same thing, it's going to be much higher than that, which is well over that 1, 2, or 3% that we're talking about. So it has no cost of living increases. What they'll do historically is every 9 to 10 years, they'll give you a 13th check. But they only do it for that 1 year. And then after that, they go back to 12 checks. So they've done that, I think, twice already over the past 20 years. So again, this is just to show you the cost of the different options and understanding how it works. Right, on the survivorship options, I'm going to go back to this. If I select option 1, and my spouse passes away first than I did, then my payment goes back to the $3,700. Right? So that's always good. All right, so these are a couple of changes. Again, some of that information already took effect because this was done back in January. So you all received the notices that the contributions into TRS towards your pension is going to be going up, right? Again, I think it's going to go ahead and stop in 2017 at 7.5, 7.7, and this is fiscal year. This is not the calendar year. So the other thing is the newest category of TRS members is age 62 and below 80. That means that by the end of this past school year, August 31st of 2014, you needed to have 5 years of service. Okay, if you had 5 years of service, then you would fall in the previous category of age 60. Otherwise, you would have to go now to age 62 and have 80 points. Okay, so again, I'm going through a lot of information. Some of them might make sense, some of them might not. If it doesn't make sense, we can talk offline about this, but I'm going to go relatively fast here. The other big change is TRS Care. There's no change to TRS Care 1, basically because it doesn't get very much coverage. TRS Care 2 and 3, you have to have a minimum age of 62. Now, if you currently have, I think it's the same criteria for grandfather members back in 2005. If you currently have 25 years of service or 70 points is your age plus your years of service, you do not need to worry about this TRS Care at age 62. However, if I'm a new teacher and I just started teaching, I'm going to have to go and wait till age 62. Now, for me, that may be fine because that's a requirement anyway, so I have to retire till age 62. But for some of those individuals that fall in the category of non-grandfather members, or they would call them tier 2 or tier 3, this is a big issue because some of you may be eligible to retire at 60, but you won't be able to get the TRS Care till 62. Okay, so again, there's a lot of numbers being thrown out there. Just know that there's a couple of changes that we need to be aware of. Now, I get this question all the time, which is, I paid into Social Security, what's going to happen with that? Because I've heard I'm not going to get any. What about my spouse's Social Security? I've heard that I'm not going to get any, right? It's not a hard yes or no answer, it's going to be, it depends. So if it talks about your own benefit, the provision is called windfall elimination provision. We didn't bring brochures on that, but you can go to Google. You go ahead and type in that name, and the first thing that will come up is that Social Security website with that PDF file on it. If you're eligible to collect Social Security, and you'll know because you'll get a statement from Social Security a month or two before your birthday, and it'll tell you how much you're going to get on the second page, then you are eligible to collect that benefit, even though you're going to collect 100% of TRS. The only catch is you're going to go ahead and fall in percentages, which if you have worked or paid into Social Security for 20 years or less, you've only collected 40% of a certain percentage of a certain part of that amount. 21 years is 45%, 22 years is 50%, and it keeps going up all up until age 29. So again, there's a lot more details into that, but just be aware that when you hear, you go to the school, you go to the office, and they say, well, you can't get your own Social Security. That's not entirely accurate. If you already have your 40 quarters, you'll be able to get it. And then the other thing, which is the government pension offset, some individuals that have been working here for a while know that back in 2005, you could quit from one school district, go and work into another school district that paid into Social Security, and then quit the day after being working, and now you have two benefits, right? Well, that only lasted for so long, obviously, because the government caught up to that, but that has to do with your own benefit, and then in addition to that, your spousal benefit. Because the question comes in, although I don't think it's fair that, my spouse is going to get Social Security, and because I'm getting TRS, I'm not going to get any of his. So first, we have to understand how that whole deal works, right? When your spouse retires, technically, and you're of retirement age based on Social Security, you're entitled to 50% of that benefit, right? Assuming that you're of retirement age. When your spouse passes away, that would go up to 100%. Well, that changes whenever you have a state pension. In this case, would be the government pension option. It will be reduced by 2/3, so for most individuals, it would be a complete wash. So you wouldn't get anything. But yet, the answer is not an immediate, no, you won't be able to get anything. It just it depends. So you have a lot of individuals in the school system that have a lower type salary, which will get a lower benefit from TRS. For those individuals, that may be the case that they're going to get a portion, 100% of their TRS, and then a portion of their spouse's Social Security. So again, the answer is it depends. All right, so retirement plan strategies. Some of you have already looked into individual retirement accounts, so IRAs, traditional or Roth. More directly, which is what's called employer-sponsored plans. It's 403Bs or Roth 403Bs. I still get some clients every now and then, they tell me, although I don't want to do a 403B, I want to do a 401k. Well, technically it's the same plan. The difference is 401ks is for-profit entities, and it has to do with how the IRS has you categorized as getting your employment income. 403Bs is the same thing. It's just section 401 paragraph K, section 403 paragraph B. It gives you the same benefits. And then 457. Understanding exactly how those work is key. One of the things that we got notification, now some from my business partner, Catherine, is that we got the new numbers for the max contributions for next year. So it's going to be 18,000 plus a catch-up provision of 6,000. So for those of you that were maxing out this year, the max out was 17,500, assuming you were under age 50. If you were age 50, it's 17,500 plus 5,500, the catch-up provision. The 457, it's also a retirement plan, but it's a different kind. It's employee deferred compensation, which just by the name of it, you have different strings attached to it. So again, all those retirement accounts work great to supplement that gap. Any major questions of what we covered on TRS? Because now I'm going to shift more on the retirement strategies and a lot of things that you should be concerned about that go beyond just the TRS benefit. So I'm always a quote guy, and I always try to put quotes whenever I can. So the quote reads, for those of you who can't read it, is the best time to plant a tree is 20 years ago. The second best time is now. So this happens because, a lot of clients that I meet say, well, I should have started, 20 years ago. I don't think it's going to do me any good now. Well, the bottom line is you got to start somewhere. Otherwise, you don't like the outcome when it comes down to it. So for those of you that haven't done planning, these are good key points that I'm going to go over. For those of you that already done some planning, it's just a review of what you've done already. So the importance of this, at what age will you retire? When I go over the benefits in TRS, I always kind of make a joke, but it's very serious, right? The first question that we answer is, when are you eligible to collect TRS benefits? Now, being eligible and being able to retire are completely different things. Right, and some of you know me personally, clients that have retired, thought that they could retire, and now they're back working, retiree hires, all that kind of stuff, because they haven't planned properly. And then for how many years will you be retired? Now that's a question that not a lot of people think about. When we run the numbers, because of life expectancy now in the US, you're going to be retired almost as long as you have been in the workforce, if not longer. If your pension does not have a cost of living increase, that's a huge problem, because it's really easy for us just to see how much the car cost 10 years, 20, and 30 years ago. Well, if you're age 60 and you're about to retire, life expectancy for females is about 92. That's 32 years. And if your pension is not going to increase, it may not be a big hit to you now at age 60, but you're going to start feeling it at 65, 70, 75. Well, guess what happens at those ages? We don't necessarily have all the ability to come back to work and get the same amount of income as we would when we started our career. Your strategies. So the first thing we're going to go over is just retirement planning, very simple. A lot of you may have questions on buying back years of service and the different ways to do it. Sick days, some of you have accumulated a large quantity of sick days, so you can go ahead and roll those over as opposed to get them in a check. Partial lump sum option, Pension maximization, that's a little bit more of a complex type strategy that we use for anyone really that has a pension. It does not work for everybody, but for the right individual, it can be a big difference. And, you know, these are just a couple, there are many more, so I just took the ones that I thought that were going to be more appealing and more interesting to you guys. So retirement planning, like I mentioned before, you have a 403B and a 457. Both of them are done on a pre-tax basis, right? There's multiple companies that do that. Some school districts have just one 457 provider, some of them have more than that. It just varies a lot by the school district and then sometimes also by your TPA. So the 403B and 457 is a pre-tax contribution, tax deferred growth, but you will be taxable when you take that money out, right? With the 403B, you have to be age 59 and a half or 55 and retired to be able to take that money without a penalty. The penalty is 10%. With a 457, you can skip that penalty if you separate from the school system. So if I'm working at a school system right now and I decide to do just a 457, and I leave that school system 10 years later, and I have a 457 account, I can actually take that money out and just pay the taxes and not have to worry about that 10% penalty. Now, is that the smartest thing to do? Probably not, because I set it up for retirement, so if I do that, I'll be starting from zero 10 years in the future. But those are some of the differences that you have in 457. Pair plans is just using the combination of the two of them. So there are some individuals that are looking for a tax deferral. So how much can I save on a pre-tax basis? Well, you can do $18,000 in a 403B and then $18,000 in a 457. So that's a substantial amount on contributions on a pre-tax basis that you can do, not including catch-up provision. And then some school districts, if you have 15 consecutive years of working in the school system, you can do an additional $3,000 a year with a maximum cap of $15,000. So if you're maxing out at $3,000 extra every single year, you can't do it for longer than 5 years because the cap is $15,000. Not all school districts have that. That has to do with the plan document, and the school district would really want to go ahead and have that. Roth 403B. This is becoming more and more popular. If you want to do a Roth 403B and you don't have it available, bring it up to your school district, bring it up to the TPA. It's not easy, it's just extra paperwork that they need to do to set it up, and now all of a sudden the whole district's going to have a Roth 403B. One key thing about a Roth 403B is that the 403B and the Roth 403B share the same cap, the same maximum. So it's not like you can do $18,000 in a regular 403B and $18,000 in the Roth 403B. So the addition of the contributions for 403B and Roth 403B cannot exceed $18,000 for 2015. All right, buying back TRS years. So some of you have known people that been in the school system. They thought they were leaving and not coming back, and they ended up coming back, and now they are looking into buying back years of service. So recently, it used to be that penalty. If you cashed out 10 years ago, $10,000 worth of years, that penalty was 6%, right? Until recently, it changed to 8%. So it's 8% going forward. Not only that, though, if you had a balance that you did not pay or did you not buy, they adjusted it retroactively. So it went up by 8%. So those lump sums of money to buy back those years of service are becoming higher and higher. And it just makes sense because now TRS is making extremely hard for those of you that can buy back years of service to buy back years of service, because TRS is not going to be in the hook for a higher payout. Longer life expectancy, everything comes into play. That's why they're pushing all these many tiers. I'm not saying it's going to get to the degree of Social Security, but they're actually taking precaution on the payouts. You can do a lump sum payment. You can go ahead, and if you have that much money sitting in cash, hey, that's a good investment if you don't have a need for it immediately. You can do a combination of both things, installment plan and lump sum payment, or you can do a qualified plan rollover. Now, if planned properly, numbers-wise, the rollover makes sense. See, when TRS receives that money, if they give you a bill, let's say you cashed out 10 years of service, you have $50,000 that you need to pay by August 31st of 2015. All TRS cares about is they receive the amount of money for $50,000. It doesn't matter if it's pre-tax or after tax, right? So if I do it pre-tax, I'm saving a whole lot of money because if I write a check from my bank account of $50,000, that means that money already paid taxes. So in reality, I gross probably about, I don't know, with taxes, 65, 70,000. So if I do it that way, I needed to gross the 65, 70,000. However, if I do it from a pre-tax perspective, 50,000 is 50,000 because it's pre-tax. I don't need to gross any more than 50,000. So again, that's one strategy to do it. If you already have the money, if you have old IRAs, all 403Bs, all 457s, that's definitely one way to do it. If you want to go ahead and get in a plan like that so that you pay it in 3 or 4 years, you could do that as well. Now, we have to look at the numbers with more detail because now every year that you wait is going to go up by 8%. However, if your tax bracket is 25% and you ended up paying 20%, still, if you wait 2 years, that's 16% compounding, right? So the numbers are not going to be accurate, but you're still saving some money there, right? So there's definitely worth to look at that plan, qualified plan all over. Sick days. You know, when you have sick days accumulated, I know there's a big uproar because they cap you, right? If you have 130 sick days, which I have clients that have that, although I have a lot of sick days, I could take the entire half of the semester off. But they cap you on the amount of sick days that they will actually pay. I think it's down to 60. Check with your district and see if you can roll over those funds into a qualified plan. Depending on your pay scale, why would you want to receive money that you're not used to getting, right? If it's 15,000, 20,000, 30,000, depending on your comp level, and pay taxes immediately. You're going to be losing 20 to 25% immediately. Why not roll it over into one of your retirement accounts and then you decide when to take out that money, right? So that's one way to look at it. Roll over, decide how much and when to get it. So that's what sick days. Partial lump sum option. With the partial lump sum option, I will stop and mention something real quick. One of the things, I'm not saying that it's 100% correct, but one of the things that you do not want to do is take a partial lump sum option and then put it in your bank account and then pay your debt. I've seen a lot of clients, I've seen a lot of people that have met with me that opt to do that. Why? Because they feel the need to pay off their mortgage or things like that. Well, if you go ahead and I'm going to take the example of like $130,000 or $140,000. If you take that lump sum of money and you add it to the income that you already made from January to August, plus what you're getting from TRX, you're going to be in the highest tax bracket. So you're paying almost a third of that $130,000, $140,000 in taxes in order for you to have it in the bank. Now, if you make that decision, now there goes the taxes, right? You're at the highest tax bracket that you're ever going to be because the following year, your standard annuity dropped. You took a massive pay cut because you retired, so now the next year you're not going to pay as much in taxes. But that 1 year, now you have $100,000 in the checking account. Let's say that you do pay off the house, or you pay off the house, but now you're stuck with a monthly payment, right? Remember that first presentation? That's going to last for the rest of your retirement, right? So that's not good. The other thing is, when you have that much money sitting in cash, I've seen it. Not that you don't want to be a good family member, but all of a sudden emergencies start happening, something needs to get fixed in the house, so even if you plan on just leaving that money in a savings account, that $100,000, the average time frame is 5 years that $100,000 is going to go to zero. And then you're back into a lower payment, and now you don't have that $100,000. So that's why the partial lump sum option is not for everybody. It's also not for you if it's going to put you in the mode of paycheck to paycheck. Because remember, TRS does not have a cost of living allowance, so you don't want to live paycheck to paycheck the first year where you retire, because guess what's going to happen 10, 15, 20 years down the road. So if you do qualify for, or if it does make sense for you and your budget and your financial situation to get a partial lump sum option, and there's many different reasons why people opt to go that way. You can roll it over withdraw the interest only, and then just leave an inheritance if that's the case. Or start taking more than the interest that's generating and spend that money, but do it gradually, do it with a plan. Right? So that's if you qualify or if it makes sense to get a partial lump sum option. All right, so this is the pension. How much time do I have? 5 minutes probably? So this is where it gets a little bit more complicated. So this will make sense if you have seen the survivorship options already, and if you're close to retirement or you've had friends that are retired, right? So in order to go into the pension maximization strategy, that applies to everyone that has a pension, not only TRS people, but just everyone that has a pension. You have to understand the survivorship options, right? And I alluded to a lot of the information in the first presentation. So survivorship options, you have the standard annuity, and then you get to select the survivorship options, right? If I pass away, does my wife get some? So in example one, I retire, right? And the next thing is, in order for it to function the way it's supposed to function, I pass away, my spouse gets that benefit, and then my spouse passes away, and then after that, there's no benefit. Right? That's the way it's structured. No one else gets benefit after that. Now, it has a little asterisk there because it depends, right? If I retire today and I pass away in 2 months, and then my wife would get something and she passes away in 6 months, then there's still an account balance there of your original contributions that someone will still receive. But if you're talking about 10, 3, 5, 4 years, 7 years into the future, there is no benefit. So then that stops, that benefit stops right away, so you can stop after 5 years. In example 2, I retire, my spouse passes away, so then what happens? It goes back to my standard annuity, right? That extra payment that I was making, the cost, it goes back to the original payment, so there's no cost or benefit because my spouse has passed away. But then I pass away, there's no more benefit, right? So the key is understanding that the moment you select any survivorship options from any pension is going to come at a cost to you. So basically what the pension is doing, right, and this is all at the institutional level. If my standard annuity, to make the math easy for me, is $4,000, and for my spouse to get 100%, it drops to $3,000. That means that I'm going to start receiving $3,000, and if I pass away, my spouse receives $3,000. The cost to me is $1,000, right? Because I'm paying that to have that covered. So basically, what they're doing is they're leveraging that $1,000. So if you pass away, that cost that you're paying will go ahead and offset the premium that they have to pay for the rest of the life. The way you look at it as an individual or as a financial planner is basically all we're doing is you're taking that $1,000, buying a big enough life insurance policy so that when I pass away, the death benefit is large enough so that my wife gets $3,000, right? So pension max, again, it doesn't apply for everybody because not when we talk about insurance and life insurance, the whole health issue comes into play, my age comes into play, but sometimes it works. So then what happens is, if I opt to get the standard annuity and collect that $4,000 and take that $1,000 to buy a life insurance big enough so that the interest can pay my wife $3,000, then if I pass away, the death benefit pays out, right? The life insurance pays out, and then it's put in the vehicle that you live just off the interest that would have to be the equivalent of that $3,000 to make sense in order for the strategy to make sense. Well, when my spouse passes away, if she only took the interest, then she would still have the principal, or they would still have the principal after she died. So then you create an inheritance. So that's why that last bullet point has ideas, trust, create legacy. So that's how some individuals, again, it doesn't apply for everybody, but that's how some individuals get to create trust, gets to create legacy, get to create stuff for your children, grandchildren, and then the next generation, right? So again, it doesn't apply for everybody, but this is a good concept that if you meet all the certain criteria, it's worth looking at. The next scenario, example 2, is, well, if I'm paying that $1,000 and my spouse passes away, well, I don't need necessarily that benefit anymore. So I can go ahead and take the full $1,000 so I can go ahead and cancel the policy, right? Because my wife's no longer alive, so I can go ahead and do the same thing as I did with the TRX survivorship option. So then I will go ahead and bring it up to 4,000. But, then we'll get the full standard annuity. But if I have had the policy for a while, and it's a permanent policy, it may have some cash value. And if it does, I can opt to get that cash value out. Now, how much, I have no idea, because there's different types of life insurance that have different types of surrender charges that work differently. But you can have an option to get that cash value out if it's structured properly. Or I can decide to keep paying it, right? Because now I'm more interested in the whole idea of living something for my children and my grandchildren and all that, and I'm financially able to do it. Well, then I can keep doing it if I can cash it out and then leave an inheritance, right? So that's what it's called, pension max. Whichever way you go, whether you qualify for the pension max or the survivorship options for your pension, there's still going to be a cost involved. What this is doing is it's only looking for options to see if you're better off putting that extra $1,000 somewhere else that would potentially give you the same benefit. All right, so I've got finished with a couple of challenges that, again, not a lot of people think about. Longevity, is outliving your retirement funds a possibility? Remember what I said, we're going to be retired longer than we actually work for some individuals. So is that a possibility? Is my lump sum amount of money in a 403b, 401k IRA, is that going to go to zero before I actually pass away? So that's the type of concern that some individuals have. Inflation, will your purchasing power keep up pace, right? If you have your 403b in a fixed account making 3%, well, that's fine. But if what the things you're buying are going higher than that 3%, then you're not necessarily adjusting for inflation. Volatility, are you prepared to ride the ups and downs of the market? Interest rates, the previous presentation talked about interest rates. And then taxes. The cost of taxes can impact the value of your retirement account. That's why it's important to consider not only 457s and 403bs, but Roth 403bs, Roth IRAs, other vehicles that can give you tax-free money whenever you retire. Because at retirement, you also want to have control over how much taxes you're paying. And the only way you're going to have control over that is if you have from both buckets, the taxable and the tax-free. So if taxes are high when you retire, you'll probably be dipping more into your tax-free bucket. If taxes are the same or lower, then you'll be dipping more into your taxable bucket. So again, it's all about strategies. Any questions? The presentations are good.
Can you take money out at 59 and a half, put it into a Roth 403b, and continue to work?
Take it out from where?
An annuity. Can you start taking money out of a non-educational, an IRA at 59 and a half, continue to work, and take that money
and put it into, well, if you do it Roth, any employer sponsor plan, Roth 403b, 403b or 457 has to be payroll deducted. So it's not like you can take that IRA annuity check and take it and transfer it directly to a Roth 403b. The way you would do it is you would cash the exact same amount of money that would be deducted from your payroll. The key to all that is you have to have earned income, which in this case you can do. Or you can do a conversion. But a conversion meaning that you have $100,000 in an IRA and you would want to convert it to a Roth 403b or Roth IRA. The only issue with that is you're going to have to pay the taxes. And it's a large amount of taxes. Now, if you're at age 59 and a half, remember the benefit from anything Roth is on the tax growth, right? So if you tell me I'm going to take this IRA account, put it in a Roth account, and then be conservative because I'm close to retirement, it gives you no benefit. Well, exception when you're going to have even inheritance, which is tax-free, but for you personally, it gives you no value if you're going to do a Roth and then be conservative, right? Did that answer your question?
Yeah.
Kind of, sort of?
Yeah.
Sorry.
So when you retire, you have, is it 50 days of state leave, state sick leave that you have accumulated? Can you buy an extra year for retirement?
Yes, you can. You can buy that extra year.
How do they calculate how much you have to pay in?
They calculate based on how much benefit is that gonna give your pension payout. And then the age that you're doing it, so they go and look at actuarial tables, mortality tables and all that, and then based on that, they calculate the amount. Buying back years because of sick leave and technical experience, meaning that you were an engineer before and now you're giving engineering classes at a K-12 level. You can also buy years of service based on those experiences, but those are the most expensive ways to buy back years, to buy years of service.
Is it generally worth buying back something like that?
Well, see, if you would have asked me that question 3 years ago, I would say yes, definitely. Now with the increases, it just depends. I just told the client that it wasn't worth it for her 2 years ago, or a year and a half ago, because it was gonna be too expensive. It would cost her too much from her 403B money and an extra check just to get an extra 2.3% of coverage. And her age and all that didn't make sense at that time. But it's getting to that point where the formulas are discouraging people from actually pursuing buying those years. And it's what TRS wants, and they don't want to keep paying you more for a longer period of time. Anything else? All right, so I have my contact information. I'm sure I'm going to leave here as soon as I'm done here, but Catherine's going to stay here for a little bit of minutes. If you guys have questions after the whole session is done, we'll be happy to reach out. Thank you.
You wouldn't expect to see a crude oil production chart in a school finance presentation, but we'll connect all these dots later. One of the things we want to point out to folks is the connection between our state's economy and what we're going to be talking about in the next legislative session. What you see up here is the production of crude oil going back to 2004, just a decade ago. And you can see starting in 2010 and then increasing rapidly, the production of oil in Texas has been skyrocketing. And that's combined with the price of oil, which until very recently held pretty steady in the $100 or so barrel range, to create a whole lot of additional oil revenue for the state. And a lot of that oil revenue feeds into the state's rainy day fund. I'll explain that connection a little bit more in a second. Pretty much the same story about natural gas. It's not quite as dramatic, but if you go back to 2003, production was a little less than 14,000 cubic feet per day. And in 2012, it's up around 19,000 cubic feet per day. Pretty dramatic increase in production of gas. Unlike oil, though, the price of gas is kind of drifted down and is fairly low by historical standards compared to oil. The impact on the state's rainy day fund is very dramatic. Those two taxes, oil production taxes and natural gas production taxes, provide the vast majority of revenues to the state's rainy day fund. Why am I talking about rainy day fund? Well, people are always curious about spending the rainy day fund and how much money is going to be in it. It is a reserve account. It isn't part of the state's general fund balance like you all see as fund balances each year. And by the way, I ask this favor of everybody every time the subject of fund balances comes up, and I just sort of mention the word. Don't call your general fund balance a rainy day fund. Don't call it a savings account. It is your checking account balance. That's all it is. You don't want to drain it to zero. So do me a favor, please. Rainy day fund for the state, though, isn't used. It actually takes a lot of effort to get it out of there, and it just piles up over time. You can see here the gas production taxes were the major contributor through most of the 2000s to the rainy day fund balance. And oil has been a more modest feature until that production started ramping up. So now we've got oil production making up a big chunk of the rainy day fund deposits. This is cumulative, by the way. This isn't an annual amount. So what you see here is what's been deposited going back to 2004. And that's kind of important to think about for a minute. Back here in 2004, there's very little money going into the rainy day fund. Well, if you look back in the past couple of legislative sessions about statements about the state's rainy day fund, oh, we have to have a big balance in that fund, we've got to have at least X billions of dollars. Fund's never had that kind of money in it before. It typically had a few hundred million, maybe $1 billion for 20 years, and then all of a sudden, it's a sacred fund that has to have, you know, $6, $7, $8 billion in it. The legislature historically has spent money from the rainy day fund for all sorts of things. It has only recently become kind of a sacred cow that even in a rainy day, like 2011, you couldn't use the rainy day fund to deal with the problems the state had in financing state government, not just in public education. So over the past little more than a decade, we've got deposits into the fund of about $15 billion from the mineral sources. The uses of the fund over that time period have been much less significant. We've got fairly minimal amounts in the early part of the 2000s, and then in 2011 we used a fairly big chunk because the state was in a deep hole and had to find some way to fix its financing problems. In 2013-14, we also used a little bit. This $2 billion here is the water fund that was set up by constitutional amendment last year. The way the rainy day fund gets money from the oil and gas taxes is that 75% of the revenues that exceed the 1987 level of those specific taxes, each one, I think oil is about 550 million, and natural gas is like 590 million. Any revenue that exceeds those total dollar amounts, 75% gets deposited to the state's rainy day fund. The other 25% goes off to the state's general fund and it's used for current appropriation. Once money's in the fund, it takes a kind of a super majority to pull it out. If it's for use for a current biennium's emergency, it only takes 60% to vote in each chamber. If it's for a future biennium, say they wanted to fund part of public ed next biennium from the rainy day fund, well, they need a 2/3 vote in each chamber. So something to keep in mind. The fund can also receive half of any ending balance in the state's general fund that isn't appropriated. However, the state has a history of appropriating virtually everything that's out there until very recently. So we haven't had a whole lot of money going into the fund because of that. Ending balances for the fund have reached very significant levels. I mentioned early on in 2004, 2005, there was effectively no balance in the state's rainy day fund. As of 2010, we had almost $8 billion in forecast. For 2015, the end of this state fiscal biennium is $8.5 billion. Many people think it's probably going to be significantly over $9 billion. And that's at a time when the legislature is about to see all sorts of new money available to spend, which is the next part of this discussion. In fiscal 2014, tax revenues for the state exceeded the controller's official certification revenue estimate by over $2 billion. You'll note that the two biggest ones, sales tax here and oil and gas here, go to kind of different places. This all goes to the state's general fund, typically gets used for funding all sorts of government purposes, including public education. But 3/4 of this amount ends up over in the rainy day fund, so it's kind of locked away. The net effect on the state's general fund was probably in the range of about $1.3 billion, more than what the controller had forecast. Okay, and the growth doesn't show any signs of letting up. There are some small clouds on the horizon. Oil and gas in particular may have some issues coming up. There was a news item just a week or two ago in the Wall Street Journal indicating that the Saudis are willing to sell oil to the U.S. at $60 a barrel. Well, if they sell it at $60 a barrel, but it takes 70 to produce in the U.S., that's probably going to put a damper on U.S. production. Certainly put a damper on exploration in the U.S. Part of that is maybe while wound up in all sorts of geopolitics that go way beyond what we need to talk about in terms of financing the state government, other than to say, if the price of oil dips much further, then we're probably not going to see those big surpluses of funds coming in from oil and gas receipts. It probably is going to be a bit more moderate. But we won't really know what the official forecasts are going to be until sometime in early January, when the state's official revenue estimate comes out for next legislative session. But at least for the first year of this biennium, we're way ahead of where the controller said we would be. And at the time the controller's initial forecast was made for tax revenues, she was forecasting we'd have about $2.5 billion as an ending balance in the state's general fund. A very sizable amount of money on its own. And now we've got another pot to add to it that's not part of that because she didn't forecast this additional revenue. In fact, if you look at where we're at, the $2.5 billion official forecast, plus a number here that I've kind of guesstimated at $3 billion for the current biennium's revenues that exceed the controller's forecast that will affect the general fund. And then yes, at the next biennium's, which is purely a guess at this point, growth in additional revenues of say $5 billion. The legislature's got $10 billion worth of new money to work with. They haven't faced that kind of new money available in probably the last 15 years. And part of that is the oil and gas economy of this state. The fact that it is booming in terms of exploration, it is booming in terms of refining. A lot of that has repercussions not just for oil and gas taxes, but also for the sales tax because the businesses that buy equipment and that sort of thing. So we're looking at a legislative session that has an historically high amount in the rainy day fund and a historically high amount of available funds to appropriate in the general fund process, the general revenue fund of the state. So probably no problems with funding current services for public education, as well as all the other services of state government. In fact, public education will probably cost the legislature less next biennium than it did this biennium because of what's happened to property values. And so the demand for money to fund the current services of public education is going down at the same time as revenue is going through the roof. Well, we'll come back to that subject and talk about what the potentials are in a little bit. I mentioned the clouds on the revenue forecast side. The state budget's not perfect. It has some holes in it. One of the biggest holes is Medicaid shortfall. The legislature intentionally underappropriated Medicaid. They did that back in 2011. They kind of repeated it to a lesser degree in 2013. They come back to town, we've got to find a way to spend another $1 billion to $1.5 billion to fully fund the Medicaid formulas that are out there. There are some issues with doing that because there's only about $263 million left in the state's current spending limit. There is a constitutional spending limit that gets set every 2 years as the legislature comes into session. It actually happens typically this month in November. And that spending limit says, here's the most you can spend without taking a special vote to authorize higher spending. Well, there's only $263 million left of that authority. They got $1.5 billion that they need to spend. How do you balance that out? Well, you can take money that's appropriated to one agency and move it over to a different agency, like pay for Medicaid, without spending more money. But it means that that first state agency doesn't have that money to spend. That's why there's been some speculation the easiest target is to go after the Foundation School Program's August payment and delay that one more time so that they have the authority to spend that money, because the state spends on a cash basis, not on an accrual basis, so that they can spend that money in Medicaid instead of in public ed, then turn around a few days later in September of 2015 and send that money to school districts. That's one scheme. There's bound to be other schemes out there. So we're waiting to see how that emerges. But that's a problem that faces that come back in January. TRS Care has a well-known, well-established deficit at this point Originally, it was projected to be about $1 billion at the end of 2016-17. TRS has requested $875 million as an exceptional item in their appropriations request. The cost of that deficit seems to be drifting down, but it has to be satisfied because there won't be any balance in the TRS care funds to pay out insurance claims for retirees if they get down to zero. So the legislature is expected to do something like that. There's also TRS active care. How many districts here are in active care? So somewhere in the half range. Well, TRS active care has been talked about back and forth and all sorts of plan changes and that sort of thing. The anticipation is there may have to be something done about TRS active care as well in order to make it solvent again. Nobody really has a real good idea, and I don't think TRS asks for anything specific to be done. It's just that it's acknowledged that's an ongoing issue. Higher Ed has already made a pitch. Day after the election for lots of new money for construction. Other state agencies are making pitches. You've heard some promises from folks who are up for election. I think one of the first things that General Abbott, the governor-elect, said is he wants to put more DPS troopers at the border. Well, that costs money. He's also talked about ending what are called diversions of highway funds from other kinds of purposes, which in many cases goes to pay for DPS troopers too. So if you end those diversions and you employ more folks, you're going to have to find the money someplace. And they do have the money. The question is, do they have the willingness to spend it more than it is for the money's there. I mentioned earlier property taxes and property tax growth and its interaction with the Foundation School Program and how the costs of the Foundation School Program are going down. We did a chart somewhat like this back when the Texas taxpayer lawsuit was going on to kind of summarize what we thought the legislature had done in their 2013 appropriations. And the point of that was they claimed to have restored $3.4 billion in formula funding for public education. But if you look carefully at the amounts that were appropriated, we were coming up with something substantially less than $2 billion of cost to the state's general revenue for that $3.4 billion benefit. And we were kind of comforted to find a chart from the legislative budget board that more or less confirms it. It's not exactly the same as ours because it's an all funds look. We're trying to restrict it to just general fund for the state. Basically, if you look at the current biennium, LBB estimated a cost for student growth of about $2.2 billion. They see that property value growth at the level specified here, little over 4% for a couple of years and just at 4%, that tax year 2014, saved the state $2.8 billion. Because when property values go up, state aid gets cut. It's a simple rule. It's more prevalent, more emphatic in the current finance structure than it's ever been. Gains in value don't stay with school districts. It reduces state costs, so there's no way you can, from a gain in property value, effectively lower tax rates, even though that's the expectation of most property taxpayers. There were also savings from settle-up from the previous biennium worth almost $1 billion, partly because of the property value growth. And then we had some additional costs like EDA, IFA support, changes in district tax rates, a little bit of additional money for textbooks, so forth. All that added about $500 million. So altogether, property value growth and settle up paid for more than the cost of student growth. And the legislature basically walked away and said, we're done, and saved $1 billion. Instead, they decided, okay, we'll restore some of that money that we took away in 2011. We'll put back $3.4 billion of it by eliminating the regular program adjustment factor and by increasing the basic allotment in 2 stages. And so they ended up spending in all funds $2.5 billion last biennium to get $2.2 billion worth of growth and $3.4 billion worth of formula change and another $500 million of other assorted increases paid for. Basically, property taxpayers paid for the bulk of that. The legislature didn't have to use a lot of general revenue to pay for it. And that's exactly what's about to happen this next biennium with what's happening with property value growth. Because during this period, the growth was at a little over 4%. The controller in October came out with her forecast of property value growth. Her estimate for tax year 14 is statewide 8.7-something% growth. Contrasted to the 4% here. That was the estimate 2 years ago. Her forecast for tax years 15 and 16 both exceed 5% growth. It doesn't take 5% growth to cover the cost of enrollment growth in the current formula system. It's a great opportunity for the legislature to reinvest that money in public education, change the formulas, increase the support. But the question really is the willingness there to do that. Okay, we just finished talking about property taxes and their relationship to funding the foundation school program and how that's going to be an even lower cost next biennium for the legislature unless they go in and do something like improve the formulas. There are other options for the legislature though. The one that gets talked about frequently is property tax changes in the form of tax relief. We've heard all sorts of ideas pop up out there about appraisal caps and lowering or the appraisal cap limits that apply to homestead properties now. We've talked about expanding homestead exemptions in various political forms over the course of the election cycle. There are also transparency initiatives that have come up from time to time, particularly last legislative session. We saw a number of these, mostly directed at putting scary stuff on ballots related to school bonds. Things like the total amount of outstanding debt, that sort of stuff. We've also got a move to have all elections on the November general election date. I've heard school districts express both positive and negative concerns about that. Some of them would really prefer to do everything in November simply because they know they can get a good turnout from folks who support their school district. Others are worried that it just brings out a lot of folks who don't go all the way down the ballot to see the races that are of concern in the school district, either from a school board member standpoint or ballot measures for school bonds, that sort of thing. So we're likely to see a number of these things come back in this next legislative session. The pre-filing of bills begins next Tuesday. I believe it's next Tuesday, it might be Monday. So at that point, we'll see who files what in the early rounds of legislating, but that process goes on for several months. It basically doesn't end until, I think, sometime in March or thereabouts. We have the exact cutoff for a newly filed bill. So we're seeing a lot of these things talked about from time to time and are likely to see come back as proposed legislation this next time around. As I mentioned, we also have heard the tax relief mantra, and in particular, our newly elected Lieutenant Governor Dan Patrick, who's from this area, had a debate with his opponent recently, in which I believe he was heard to say, this is a quote from the newspaper, so I didn't listen to the debate myself, but he explained a tax swap where you get a $2,000 reduction in property taxes and pay maybe $200 more in sales taxes and come out $1,800 ahead. His idea was swap taxes on the property tax side for increased sales tax, and presumption being that a lot of homeowners would come out ahead. Well, how many of you have ever been a math teacher? You can't really do this trade and come out ahead. If that's all you're going to raise is $200, you've got to be expecting somebody else to be paying the $1,800, or you come out behind. We came out behind in 2006 with tax compression because the taxes that the legislature created to replace the lost property tax weren't nearly enough. And the state limped along for a few years, covering the deficit with assorted other mechanisms, including federal stimulus money that paid for part of the foundation school program when that was available. And then ultimately got to 2011, and they didn't have any way to cover it. That's why they cut public education. They just couldn't afford it in the budget structure that they had created with that round of tax compression. Well, we're hearing a lot of that same sort of talk again. We've got to do something about property taxes. Yes, they're unpopular, but the legislature relies heavily on property taxes to keep from having to pay from other sources for the foundation school program. So it's kind of a really tough dilemma they're facing. They know it's an unpopular tax. They want to do something about it, but it's vital to the way that they fund public education. So it's a tough thing that they're embarking on. Just kind of talk about the general math of things. A penny of sales tax, by most recent estimates, raises about $4.25 billion. It would vary depending on how it's applied and whether it goes up by half a penny or 1.5 pennies or whatever, because the economists get involved and say, well, once the prices go higher, people stop buying as much, et cetera, et cetera. But basically, it's worth about $4.25 billion, and that's roughly equivalent to about a 20-cent tax rate on property taxes statewide. So if you're talking about massive tax relief on the property tax side, it's going to take quite a few pennies to cover that. And that, 20 cents of property tax is only the school taxes. There are also all the other tax jurisdictions at the local level where there is no direct state support or relationship like there is in the foundation school program. So if there's an insistence on a mandatory across the board, $50,000 homestead exemption, it's just a number. And every taxing jurisdiction has to do it. Cities, counties, MUDs, everywhere. The state would then have to find a way to flow money to all those other entities, and it just doesn't have that mechanism. But those are the sort of ideas that are starting to pop up more commonly when the legislature talks about things for the next session. In fact, one of Dan Patrick's victory speech items that he had on election night was property tax relief. He's going to make sure that happens. He's lieutenant governor. He sets the agenda in the Senate. There's a good likelihood that something's going to happen. Okay? Along with property taxes, the legislature has also talked quite a bit about the business tax that it restructured as part of the tax relief in 2006 and trying to get rid of that. The franchise tax brings in basically what 1 penny of sales tax brings in. And so there's a move afoot to eliminate that business tax. It doesn't mean that businesses wouldn't pay other taxes. They pay sales taxes, they would pay property taxes, but they wouldn't pay the franchise tax. Turning to the court case, it's been out there for quite a while now. I'm not going to spend a great deal of time talking about this. It's really just a reminder. The judge in the Texas taxpayer lawsuit said the system is inadequate, arbitrary, unsuitable, inequitable, and fails to provide meaningful discretion. These all come back to bear with whatever the legislature decides to do with respect to funding schools, either from the formula allocation side of things or from the property tax relief side of things. Because it's hard to see how you trim back on property taxes, yet still give meaningful discretion to school districts whose only other recourse for revenue is going to be property taxes. So it is going to be a continuing issue in the legislature. The court did issue an injunction against distribution of the funds for public education and the implementation of Chapter 41, but that stayed until July 1 of 2015. It's expected, and what the state has already said, it's going to the Supreme Court to file an appeal. We have here best cases and more realistic cases in terms of deadlines of things. There was some anticipation under a best case scenario that an appeal would be filed by the end of September. I think they were pretty close to that. But it isn't real clear if the Supreme Court's going to take up the case until sometime next year. It certainly hasn't said anything about it since the AG filed notice of appeal. The schedule for briefings is more likely to be sometime in the spring of 2015, and oral arguments before the Supreme Court probably in summer. Under a better case scenario, you might see it as early as May or June. It's pretty clear the Supreme Court's not going to tell the legislature anything by the time the regular session is over this next year. It will be after that. And that prompts a lot of speculation about will there be a special session, or will they just put it off until 2007? And in large part, that's up to the Supreme Court and what they tell the legislature they can or cannot do. There's also been a lot of discussion about what it is the Supreme Court will direct the legislature to do, and the answer to that is basically not much of anything. Courts historically, and particularly the Texas Supreme Court, have simply said it's unconstitutional, you have to fix it. It may give some indication of how it's unconstitutional, and probably should. But it's not going to say you have to give property tax relief of at least 20 cents, or you have to improve the homestead exemption, or you have to fund a basic allotment of $5,700, or anything specific. So the Supreme Court's going to tell the legislature, here's what your problem is, but it's not going to offer a solution. Okay, it's not going to tell them, this is how you must fix it. Our Supreme Court takes a hands-off attitude with respect to that. Never has been very specific. So when you look at what the judge has said, you've got kind of the broadest, most comprehensive statement of an unconstitutional system that we've ever had. In the past with Edgewood, we had an inequitable system. With West Orange Cove, we had, a state property tax. Now you've got one where it's all the things that could possibly be wrong with the Constitution. So the notion here is this is going to take a lot of work to fix where we've got ourselves to at this point. There's been some reaction from the legislature regarding changing the standards for the testing programs and that sort of thing. There was obviously some changes last legislative session that school districts viewed generally favorably in terms of House Bill 5. But a lot of that came about as a result of continued pressure on the state's testing program. However, there was very little in the way of support coming from the state for all the changes, and I think many of you dealing with finance school districts realize that some of those changes do require some extra resources. You've got more counseling responsibilities, you've got more graduation planning you have to provide, you've got more things you've got to do. The legislature kind of views that as, oh, well, you just have to shift this and shift that. Well, no, you can't abandon this in order to provide that, because the law says you got to do both of them. And so, I think we're taking the opportunity whenever we have it to remind the legislature that choice is not going to be cheaper. Having more degree or more diploma options is not going to be cheaper. It means you've got to have a lot more variety, a lot more people with different skills, and have them available in a lot more places than you historically have had. And so it has cost consequences. They may not have thought that when they passed House Bill 5, but I think most school districts think that in terms of how it's had an impact on them. It's not that it's a bad thing to do, it's that you need the money and support for that. The legislature hasn't really talked too deeply about many of the issues that they're facing. They've had a few interim hearings on various committees. There's another one coming up next week, the week after that, I think on the 17th, dealing with choice, facilities, a bunch of other issues that are maybe more contentious than some of the other interim stuff they've done on the Senate side. And that's actually kind of a historical trivia note. Senator Dan Patrick will chair a meeting of the Senate Education Committee as the Lieutenant Governor-elect, and his opponent, Senator Vandekute, sits on that same committee. Now that has not happened in anybody's living memory. So just kind of those legislative things, it's very rare for a sitting senator to become lieutenant governor, and then to have a hearing and his opponent be there at the same time as the Strange stuff. Obviously, we've got a lot of new faces. We've already talked about Dan Patrick, we talked about Greg Abbott. We also have a new Attorney General, Ken Paxton, Comptroller Glenn Hager, and Agriculture Commissioner Sid Miller, and new Chief Justice, and new Land Commissioner George P. Bush, and gosh, I can't even think of all these names out there. So many. We've got 25 new House members, which are added to 38 who are only going to be in their second term. If you go back to those who've been there, who will be there their third time around, there's a big turnover 3 years ago, or 3 cycles ago as well. So we've got a whole lot of new House members. We've got 7 new senators, 3 of them have been in the House before, and 5 more senators, it's only their second session. So a third of the Senate is at most only in their second session. It's a lot of rookies and a lot of soft points. And then the Commissioner of Education, whose term is overlaps that of the governor. Greg Abbott hasn't said one thing one way or the other about whether he's going to keep Commissioner Williams or choose someone else. So you may have turnover at the head of the TEA at the same time as all the legislators. Major issues, other than the ones we've already started to talk about, we've continued to hear talk about achievement school districts. Those school districts that will be set up for purposes of taking campuses that are not performing and pulling them in and kind of taking them away from school districts until they're improved enough to get them back. There's all sorts of issues and problems with doing that sort of thing, but it seems to draw some support in certain quarters. The notions of taxpayer savings grants, opportunity scholarships, other terms for vouchers, that keeps coming up. Some of that may lead into the next Senate Education Committee hearing on choice. We're not quite sure yet. Virtual schools is always an issue that's kind of lurking out there, and then expansion of charters. And we already talked quite a bit about property tax and transparency. So there's lots of things on the table, not necessarily all of which are directly finance related. Some of them are broader educational policy issues, but most of them have finance repercussions. We've talked a bit about an estimate of the surplus, but the true estimate won't come out until the controller's revenue estimate is issued in January. Typically it is, I said January 14th, that's not right, January 15th. Typically it occurs the day before the legislature begins. And the legislature begins on a Tuesday, I think it's the second Tuesday of the month, so the day before that we're likely to see a revenue estimate. It will not be Susan Combs' name on that revenue estimate. Glenn Hager is the incoming controller, and if you're not part of the legislature or the lieutenant governor or the governor, you get sworn in on January 1. So Glenn Hager takes office January 1, and it will be Glenn Hager's revenue estimate, although given that you don't have only a few days as controller to say anything about it, it's highly likely that the staff of the controller's office is going to be the one doing all the revenue estimating. And so we'll see what that says, but at that point we'll have some sense of what the official forecast is for surplus funds. The state spending limit that I referred to earlier, it's a constitutional spending limit. Historically, it's been based on the growth of personal income in the state. There have been a lot of folks advocating for something a bit more restrictive, like inflation and population growth, which actually would be a more restrictive limitation, particularly now, because incomes in the state, personal incomes, are going up fairly significantly for Texas. That will happen sometime in late November, some date. But typically it occurs in November. The folks who will set that are the current group. The Legislative Budget Board, which is a board of 10 sitting members of the legislature and the lieutenant, 8 members of the legislature, plus the speaker, plus the lieutenant governor. They make a recommendation to a committee that's made up of the governor, lieutenant governor, speaker, and controller. There's an overlap there in terms of membership. And they make a recommendation of what the spending limit should be, and if that committee does not have an objection, then that goes into force. If they do, then there's some other things that happen. But typically that takes place in November. And that will then say you can only appropriate X amount of money from funds that aren't otherwise dedicated by the state constitution. In order to exceed that limit, and remember, they got a lot of money laying around, and if they were to try to spend it all, they most likely would exceed that limit. It takes a simple majority vote in each chamber. But no one wants to take that vote because it's seen as kind of that third rail. If you touch it, you're going to get fried. You don't want to exceed a constitutional spending limit, even though all it takes is a majority vote in each chamber. We talked about the rainy day fund. It does require either a 2/3 or at least a 60% vote to use any of that money. But like I said, they're probably going to have way more money in the state general fund than they will need in order to cover basic needs. It's hard to imagine how they get to the state's rainy day fund this coming legislative session. Something really bad has to happen. We've got lots of folks arguing for lots of different causes, and lurking in the background, of course, is the court case related to public ed funding. So what does the legislature do? Well, you can make an argument that they ought to fund enrollment growth. We've already seen that's probably going to cost them zero. You can make an argument they should fund at least inflation. Some level of formula improvement, they probably can do that with minimum cost. A 2% inflation rate in public education is probably $600 million a year, so you add 600 plus another 600 and the base of 600 from the second, it's about $2 billion to cover inflation. But the cost of the program is going down because of value growth, so it probably is only a little bit more than what they would normally put in to cover employment growth to cover inflation as well. So the capability is there. The question is, if you've committed your resources to something like property tax reduction, funding enrollment growth and inflation at the same time, becomes a little more challenging. Will the legislature reserve funds for the Supreme Court decision? That decision is not going to happen during the regular session. Almost no likelihood it would happen during regular session. So it's going to be after that. And the question really is, if you hold money back for that, that means other agencies, higher ed, water, health and human services, Department of Public Safety, they all are out there looking for money. It's kind of hard to hang on to it sometimes. So it may be a challenge to reserve funds for whatever the Supreme Court is going to say. Plus, you have leadership that may have convinced themselves that the Supreme Court's not going to side with school districts. And so maybe they're not motivated to save any money back. And that makes it more difficult to do it when the Supreme Court does say for something. You could dedicate rainy day funds to the public education cause. We just voted to do that with highway funds. The highway funds are going to siphon off half of what otherwise would have gone into the rainy day fund, basically diverting some of that oil and gas tax revenue to highways. We could do the same thing with public ed if we wanted to. Just have to pass constitutional amendments, so we have to wait a while to see that resolved. It's possible the legislature will more directly attempt to address some of the things that Judge Deeds brought up in his opinion. I think people don't really hold out a whole lot of hope that's going to happen, but it's possible. That's one of the options. And then you could look at a repeat of 2013, some incremental improvement in some of the sore spots of public education as ways of beginning to address the issue. But when you look at the school finance system, there's a whole lot we can do to improve. We've got a system that structurally dates back to about 1984. Recapture is about the only feature of it that isn't really part of what was envisioned in 1984. We've got a system whose basic allotment structure has been around for 30 years now. It has changed, obviously, but it's basically the same structure. Many of the weights that we have date from that time period. The transportation allotment we have dates from that time period. It is a system that is out of date. It needs some real thoughtful work to get back to something that meets our needs as a state. Things have changed an awful lot here in 30 years. And we've got a different population, different expectations, different economy than we had in 1984. So there are lots of things that need some attention. Our equalization provisions are 20 plus years old now. We've been equalizing with recapture in one form or another for 20 plus years. The legislature, when they adopted that scheme, said, oh, this is only going to be here for a couple of years till we can figure out something better. But guess what? They haven't figured it out yet. So it's still there. Our facilities equalization program started in 1999. Really haven't changed them very much. And now we've got a system in which about half of the students of the state within school districts don't get any state support for facilities whatsoever. It's deteriorated in terms of what that yield means that much. The last time we considered serious enrichment was when we did tax compression, and the legislature was kind of bound to carve out those pennies above the compressed rate as meaningful discretion. Of course, then they put the restriction on it that you have to go to the voters if you want to go above $1.04, so you can't really use all of them unless you go for an election. That needs some thought. What is meaningful discretion? How does that fit into our financing system? Particularly if we're going to make major changes to that, and maybe if you meant more tax compression as part of property tax relief. Lots of big questions working out there with finance. We need to figure out what the funding level ought to be. That's kind of a basic. You'd think we'd have some sense of that, but the state basically didn't have much evidence on that trial, and the plaintiffs had enough to convince the judge that the state didn't have a real clue what the basic law outcome ought to be, what it ought to pay for, what it ought to fund, and how much was needed to provide a general infusion of knowledge to meet the constitutional requirements. So that's kind of the environment that we're facing. We've got a lot of resources to work with that we haven't had in quite some time. We've got a lot of folks with all sorts of demands to use those resources other than to fund public education. And we've got a court, district court, saying we have a constitutional mandate to do something. So all these things are coming together in January. If you expect me to tell you exactly what's going to happen, I'll see you in June and tell you exactly what did happen. Because I don't have a clue. There's so many agendas out there, it's going to take a little while for all this to shake out with all the changes in leadership. This legislature is probably not going to have any committee hearings going until, March. It's just going to take a while for everything to shake out. Any questions? You want the retirement folks to come back up now? Okay. Well, thank you.
Well, thank you all. It's good to see you all in one place. This doesn't happen very often unless we're at TASBO at the annual conference. So this is nice to see you all here. We presented this at the Single Audit Conference in Austin. So it was a mix of state auditors, external auditors, CPAs, and then some actual folks working in government. So what I wanted to do, and there's about 15 slides that has to do with auditors, so I'll spare you. It's whenever you have some insomnia, you can read those pieces, but it just lets you know what we'll be doing, so you can ignore that. What I wanted to do was go over the current guidance, just briefly, and just show you the findings that OIGs for U.S. Department of Education and other agencies are still finding within local government, state governments, and nonprofits. This particular instance has to do with a nonprofit in Philadelphia where they had material noncompliance with the majority of grant requirements as its administration practices were inadequate to safeguard grant funds. So in the end, they questioned $19.5 million, and then this OIG, the Justice Department, said, we're going to tell you how to spend the remaining $3.7 million that's left in your grant. Okay? So this is all under the current guidance that we're operating under, okay? This has to do with the Colorado Department of Education. Again, this entity operates under Circular A87, which is for local and state governments, and that's what school districts have to abide by as well. For this Department of Education, the auditors were unable to substantiate about $23.9 million in personnel charges, so salary costs. Why? Because of time and effort, semi-annual certifications, for those that were split funded, personnel action forms or reports were not located for the employees tested. So it's an issue, and notice the date, 2008, 2009, but if the other article was a little bit more recent. But it's important to note too that A87 has been around for at least 10 years, okay, or more. The other OMB 133, the single audit, has been around at least since 1984, and we're still having these issues. So it's important to see what is ahead of us, and it's right around the corner. Because for you all, you have to implement the Uniform Grant Guidance after December 26, 2014. For us, we don't have to start auditing or applying the certain subpart of the new guidance until fiscal year 16. Okay, and I've got a grid on there to line out all of the due dates. But I just wanted to show you that we're still struggling with guidance that we've had for quite a while. So how much important is it going to be? What more important is it going to be for us to learn what's going to be required of us? Auditors are struggling as well, and have been struggling as well. So incorrect type A/B thresholds for the federal programs is still a common finding. Failure to report findings for non-compliance, failure to apply single audit requirements correctly, and then testing compliance but not focusing on controls. That last one is going to be critical for us for you all and for auditors alike, because they're going to remove a lot. They, being OMB, is going to remove the guidance that says you must use semi-annual certifications for those that are 100% funded. You must use time and effort reports. They're removing all of that. They're going to say, use whatever you need to, but if we come in to audit you, you have to substantiate that Jane Doe worked 50% on grant X and 50% out of the general fund. You're going to have to be able to show that. And if you think about it, the semi-annual certifications is just a piece of paper. I mean, you could be lying to me, right? I know you're not, but you could be lying to me. And that's all that's required. You know, we're not required to dig in further to tie up actual payroll charge and tie out the activities. So that's what they're removing. They're removing all the guidelines as to what type of documentation you should have, and telling you you have to have internal controls to substantiate, to be able to substantiate and avoid fraud, waste, and abuse, okay? And so auditors are going to have to really focus on controls. A lot of auditors will test for compliance, but not really test controls that are in place to prevent non-compliance. Okay, so you operate under OMB A87. That's cost principles. That tells you which costs are reasonable and necessary. It tells you that you can't use it for lobbying costs, you can't use it for entertainment. That's what the cost principles are there for. We also have to abide by OMB A133. That tells you that when you're in a single audit environment, which indicates that you spent more than $500,000 in federal awards in 1 year, you're subject to the Single Audit Act. So now you've got two circulars, OMB A133 and OMB A87. But as auditors, as federal agencies, well, guess what? When you go from a nonprofit to a local government to an institution of higher ed, you change cost principles. So for me, I do all three. So I have to say, okay, I'm in a nonprofit now, I have to use A122. I'm at a higher ed, I have to use A21. Oh, I'm back at a school district, I'm at A87. So I have to keep those things straight. So what they're doing now is combining all of those cost principles, regardless of what type of entity you're doing, and incorporating the A133 grants as well, the A133 guidance as well into this uniform grant guidance. You'll hear several people call it the Omni Circular, the Super Circular, but the official term that OMB uses is the Uniform Grant Guidance. Okay, so I think even some of the changes that we're seeing right now that TEA has asked you to implement, you know, we're not doing the J2 schedule anymore. That's part of it, because they're gonna ask you to prepare your indirect cost rate proposals based on their new forms. And that will be applicable for fiscal years 2016, because for 15, those were set using fiscal year 2013 numbers. So your 2014 numbers, you'll have to redo the T's upwards, so that's gonna be different. And your 14 numbers will determine your 16 rates. And so, just a little side note, we had a question from one of our clients asking, well, I need the new indirect cost rate proposal template. Well, it's not out yet. If you read that September 16th guidance, it said that mid-October it would be out. So TEA said that it's still not ready, but I'm thinking that they're still comparing it to this uniform grant guidance to see what they have to do to comply with the new procedures. So be on the lookout. They said it would come in to the administrators addressed, and if you subscribe also to the federal grant compliance feed, that it would come out here. So that's just a little side note, and you'll see how it will affect you directly and how TDA is having to implement this and make sense of it. Okay, so all of these are the circulars that are at play for all sorts of entities. Okay, your A110 and A102 are your grants and cooperative agreements. That's the administration grants. So you're under 102. School districts are under 102. And I mentioned earlier you're under A87 for cost principles, and everyone that's under a single audit has to abide by A132. Okay, this side note, the font or the letters in red, 48 CFR, the Code of Federal Regulations, that has to do with commercial organizations. Believe it or not, businesses also have to undergo a single audit because they get federal funding as well. It's rather weird, but just be aware of it that they are subject to some of this as well. Okay, so administrative requirements, cost principles, and audit requirements are three broad categories that it's included in this new grant guidance. You'll have to be concerned with the first two categories, administrative requirements and cost principles. Audit requirements is for us, and there's different implementation dates for these categories. The first two for you all, you'll have to implement after December 26, 2014. We can't apply the audit requirements to fiscal year 2016. It's for fiscal years beginning after December 26, 2014. So all of us either start July or September, so that won't be applicable. We can't audit you based on the uniform grant guidance until fiscal year 2016. However, the tricky part is you all have to administer some grants under the uniform grant guidance in fiscal year 2015. Anything that is awarded after December 26, 2014 will be in accordance with the uniform grant guidance. So you really have to pay attention to that award date. When does TEA, when does HHS, when does whoever your pass-through or your direct grantor, when do they sign that grant award letter? That's the date that you have to compare and say, am I under the uniform grant guidance or am I on the old guidance, which we're operating under right now? This is a list of the appendices. I won't read them to you, but in the back, excuse me, that didn't help at all. But in the back, you'll see the links as to where you can read up on all of this, okay? Where can I see it all? So I like the e-government site, and I linked it, but basically, this is Title II. This is all under OMBs. Title II, Subtitle A, Chapter 2, Part 200. That's the key part for you all to hone in on. When you see the guidance, it'll be 2 Code of Federal Regulations or 2 CFR, Part 200. That's all you need to know. Usually you won't see Title II, Subtitle A. But I'll show you how to navigate through that. And in the slides, you'll see that. So you go to the ecfr.gov. So you'll go to Title II, right? Okay, we're already in Subtitle A, go to the 200s, and then go to the Uniform Grant Guidance, which it'll have everything. So here's Subpart A, the parts that I alluded to before, and that's the administrative requirements. So the neat thing about this website is you can actually do a search and find for any keyword, and it'll take you there. Because each part of the new Uniform Grant Guidance is close to 200 pages. So you have to read about 600 pages of this guidance to figure out what the heck do they want us to do. So what I wanted to go over today are the key things that cause question costs. What's going to get you in trouble? So there's a lot of information, but this is where you can go and review that, and this also covers indirect cost issues. So I'm interested to see how TDA is going to implement all of this in accordance with the Uniform Grant Guidance. And as we're going through this, I want you all to think of questions and email me those questions, because at the last one, at the Charter School Roundtable, they had a really good question about the award date. And I'll get into that later. So just think of things that you're confused about, or things that you see would be an issue. If you could just, ask me about that, because there's things that you all will think about that we won't think about. We'll only be focused sometimes on the audit side. And of course, we know this is, OMB is is under President Obama or any president, and so it's coming straight from the White House, this guidance. Here are the applicable dates. So the federal government has to apply this December 26, 2014. So that's just a month away. You all have to start implementing and complying with this for any grants made or awarded after December 26, 2014. And notice that the cost principles and administrative requirements are applicable after December 26. Auditors, years beginning after December 26, 2014. So that would be any fiscal years ending. The earliest for us would be December 31st, 2015, June 30th, 2016, August 31st, 2016 for you 831s out in the group. So the key thing, the tricky part for auditors is that you're gonna have some federal awards that you're administering for the old guidance, and then you'll have some that came in after December 26th. So we're gonna have to really pay attention to those award dates and audit them accordingly. So we still have to audit the cost principles and admin requirements in fiscal year 15, but we can't apply subpart E, and I'll show you why that's key, because all the thresholds changed when you get thrown into the single audit bucket. Right now it's at 500,000. So if you're a school district that some years you're in a single audit situation and some years you're not, you're borderline 500, it's moving up to 750. So for your large districts, you're never going to make a moot point, right? But for those of you that are borderline, it's going to make a difference. You may not have to have a single audit, and that's great news. It alleviates a lot of that burden of having to go through that single audit. So there's no early implementation for auditors or for anyone, so that's good. Usually GASB encourages early implementation, but there's none of that. I always say in other presentations that the compliance supplement under OMB 133 is your cheat sheet. And so the 2015 compliance supplement is going to have a sneak peek of how we're supposed to audit you all. And there, we have 14 compliance requirements, all the way from activities allowed to subrecipient monitoring, procurement. We have all these requirements we have to audit you under, but they're saying that maybe in 2016 they're going to eliminate some of the special reporting requirements that we have, which is true, because there's some things that we don't know. The instructional side, instructional reports that you all have to prepare, well, we don't have a clue about that. We're financial statement auditors. Right? We just did an audit for a research and development company that actually had to have, it's a commercial entity, and they had world-renowned scientists performing these, or preparing these performance reports, and it had DNA formulas, and I'm thinking, well, they submitted it and it's on time, but how are we supposed to know what all those formulas, because I'm not a doctor, right? That's not in part of my skills. So they're going to remove those odd things that auditors really have no business looking at and would not even know if it's correct or not. So I like that part. Okay. So who's responsible for this? We already talked about it, OMB, but there's also another organization called the Council on Financial Assistance Reform, and you'll hear everyone refer to it as COFAR. The latest FAQ, and I suggest you read it, it's only 30 pages long, but again, you can search it for keywords, and I've done that. It has the tricky things of, okay, if I submit a grant application, let's say tomorrow, but I know it's not going to be awarded till December 27th, guess what? Even though you've submitted 7th, you're subject to the uniform grant guidance. So it has those tricky things like, well, if I submit here, but I get it awarded here, it'll take you through that whether, tells you whether it's applicable to you or not. So I'm hoping that as we're going through this, the guidance is final, but the only thing that this council is doing, and it's made up of the HHS, U.S. Department of Ed, so it's made up of the top agencies, federal agencies, and they're going through and adding clarifying guidance for you all. So they can't make any changes to the law, but they can provide clarification just like they've done in this latest FAQ. Okay, now, this grace period, the FAQ 200-110-7 is for effective dates and grace period for procurement. When we go through it, you're going to see that you're really not going to need to take advantage of the grace period for procurement because our state guidelines are more stringent than the new federal guidelines. So we're safe. Local governments in Texas, we're safe because of that $50,000 threshold and everything that TEA makes us go through for that. It's the nonprofit higher ed, it's just the higher ed entities that will really have a hard time complying with this. I will say this, if you already don't have procurement manuals in place, this is the time to get them in place because one of the things that we're going to be required to do is to verify your documentation as to what procurement standards you're following. And a lot of the school districts already do. But if you haven't, and you haven't devised that procurement manual, or your policies are not clear, I would suggest you would go back and do that. So I think if you're not complying with this procurement, well, you're probably not complying with state law, which most of us and all of us probably are that's not the case for us, okay? So it's just a tidbit that the procurement rules are going to change. This was actually there are certain awards that, let's say you're scheduled to get $100,000 one year, $100,000 the next year, so forth and so on. So for incremental funding, the federal agency can actually say, yes, the first $100,000 that you got were before the uniform grant guidance, but the next $100,000 may be under the uniform grant guidance, and they can take advantage of that time of that incremental funding and change it. Charter school asked me, which I have to email TEA about it because I was thinking about, well, what if your NOGA changes? You know when they issue a new NOGA and they re-sign and redate that NOGA? I'm wondering if that puts you in, okay, if I get one, I think that I'm done with my funding, but I get a new one after December 26th. Is that considered incremental funding? So I would like to ask TEA if they consider that when they issue new NOGAs and redate it, because that's what we have to go by, is the award date. So I'm wondering if that will throw you into that new uniform grant guidance. So you may be operating separate funding, like the new incremental funding, or changes to your award amount under a different standards and different laws. So I'm going to email TEA, and when I get an answer, I'll email that to Jesus, and he can email it to all of us. That was a good question. I'm wondering, that would be kind of a sticky situation. Now, anything that you apply for after December 26th, or you get it after that, you're under that uniform grant guidance. So that's okay. Okay, so procurement, states will follow the same policies. That's not us. Non-federal entities will follow the 5 procurement methods. There's the small purchase procedures. Before that, state and local governments had to use the guidelines for small purchases, which was $100,000. That threshold has increased to $150,000, which is in line with commercial entities, which is the Federal Acquisition Regulations, the FAR regulations. So now that small purchase amount is $150,000 or less. Okay, there's also micro purchases, sealed bids, competitive proposals, and non-competitive proposals. And I'm sure you've seen the slides that there's a nice graphic that the COFAR implemented, or an OMB, I think it's coming straight from OMB, will help you see the different procurement amounts. I don't know if you can see that, but the micro purchases are $3,000 or less, no quotations are needed. Up to $150,000, again, those are considered small purchases, only require great quotations, but again, we can't get crazy with it and say, oh, we can only get quotations for this. Remember, we have state law, which is more restrictive, and so when there's conflict between state and federal laws, we go with the more restrictive, and that state laws would trump these federal laws. And then the sealed bids is anything over 150, which applies to construction. And it's sole source. Sole source, I do not like them. I know they're necessary, but the federal government has said that they have to be very unique, has to be because of a public emergency or authorized by the federal agency, and there's truly no competition for that. And I just warn you on that because a lot of we've seen a case where 2 school districts and a county were using this sole source vendor, and they even got to sign off from an attorney saying that they were a sole source, and everyone thought that it was fine, but what was happening, they were committing fraud. It was basically kickbacks from the sole source vendor. So always use your judgment. If there is competition and you know someone else can provide the same goods or services, or at least comparable services, they're probably not a sole source. Especially here in Houston, I find it hard to believe that there's a lot of tons of sole source vendors. Maybe in smaller communities where they're out in the boonies, but not here in Houston. It's very rare for that. Okay, internal controls. I had said that the OMBA 133 compliance supplement is your cheat sheet for an audit. But part 6 of that compliance supplement is usually what we audit off of. So there are tons of examples of internal controls. And again, remember that that's going to be our focus. It's going to be internal controls surrounding all 14 compliance requirements over your federal grants. Okay, so if you don't really use the COSO framework, which is control environment, risk assessment, information and communication, control activities, if you don't use those, and you don't use the Green Book, which is the federal internal control regulations, and you don't use Part 6, the federal government says, well, I don't know what you're using. And if it's not one of these 3, I'm not sure that your controls are adequate. Another topic that just to warn you about is the subrecipient versus contractor. Okay, they're not going to be using the word vendor anymore. But always read through your contracts carefully. When you're a subrecipient, a true subrecipient, it's pretty clear when TEA gives us federal awards, we know we're a subrecipient. But sometimes there's other entities that get involved, and we don't know if we're in a contractor or vendor relationship or in a true subrecipient relationship. So I encourage you to take those contracts through this test. If you determine the eligibility you determine who can receive the federal assistance, then you're probably a subrecipient. You're responsible for programmatic decision making, you're responsible to adhere to all of OMBA 133 or this uniform grant guidance, you're probably in a subrecipient situation. You are a contractor when you provide the goods and services within normal business operations, you provide similar goods or services to many different purchasers, normally operate in a competitive environment, and the subrecipient or you, the grantee, I'm using the wrong terms, but if you're the one getting money from another entity and you're not subject to the compliance requirements, you're probably in a contractor situation. One thing that the COFAR actually had in their FAQ, it says that a lot of states will still use in their contracts the word contractor. So don't get caught up in verbiage. It's really on substance of the contract, so be careful with that. They say you, Spring ISD, are the contractor. Well, don't think, oh, okay, I'm not a subrecipient, I'm just a contractor. You really have to go through this test to determine if you're a subrecipient or a contractor. Because what that leads to, you might have a federal award out there that the auditors don't pick, you have audit failure, your single audit is rejected, and it just goes down south quickly. Okay, cost principles. Direct and indirect costs, I'll just tell you that if you've never had an indirect cost rate, the federal government says you can apply a de minimis rate of 10% or less, but that's not the case with school districts. We've always had our indirect cost rates that are coming from TEA, so we're good there. So we're just now in a wait and see pattern, a hold pattern to see what TEA is going to do with the new indirect cost rate proposal. It's supposed to come out soon. Okay, I'm going to keep going. Here, this is already what we know. Those are just examples. Okay, this is something new. Some of the large governments that I work with that are not school districts already do this. So when they request reimbursement from their pass-through entity or federal government, they include this certification at the bottom of their report, and it's basically saying that everything you submitted for reimbursement is true and valid and actual, and you're taking responsibility for it. So it has to be signed by someone an official that can legally bind the non-federal entity, and it is a legal document. So, I mean, it could be considered fraud, they could take legal action against the person certifying these things, so that will be part of it. And I believe some of the entities have said that certification is already appearing on the drawdown request that you do through your TEA. So just realize that that is going to be an essential part. And also, I've heard that the person that sometimes in small school districts, it's very hard. You're the same person that prepares the drawdown request and certifies. Well, now that's going to have to be someone different. Someone is actually going to have to be reviewing the drawdown request and certifying it. It has to be someone different than the preparer. So just be aware of that. Compensation, personal services, time and effort reporting. I've already talked about semi-annual certifications, time and effort. So again, they're going to be less prescriptive on the documentation, and they will place more emphasis on internal controls. Changes must be based on records that actually reflect the work performed. So I think that's going to be a little bit tricky, especially for your split funding. We don't have to split fund anyone, I would not. You know, if you can, even if maybe you say, I'm going to pay this person 100% out of Title I for the full semester, and they're fully funded for just the first 6 months, and then I'm going to switch them to 100% general fund funding, I would do that, but don't do the split funded because it's harder to guess.
If you do it that way, do you need to have that in the job description? Is that preferred, or?
Well, the EdFlex waiver is the substitute when you don't do your semi-annual certifications, all of that. But I think that the job description will even be critical because, again, how will we know that that person is actually performing those duties? So I think that will be one piece of evidence is the job description, especially for federally funded teachers. Be careful. Go ahead. It might be a large project for your HR people. Whoever handles those job descriptions, but sometimes it just says teacher, and that's it. And so that's kind of scary with that. So you may want to set up meetings with your HR personnel and say, okay, teacher's not going to cut it for this IDEA funded individual. We may have to rev up our job descriptions to properly show that they are IDEA employees. Okay. We've already talked about that. It may be that the semi-annual certifications, or not semi-annual, but the time and effort documentation you already have is working. It's not saying you can't use it, but you have to ask yourself, would this pass the audit test? Can I prove that this person is actually working on it? So it would be actual time records. Before, there were some, when it was very difficult to get entities in line with these requirements. Some were using just calendars and saying, yeah, I think I spent 4 hours on this grant, and then 4 hours were out of the just normal administrative duties. So I think that's general funding. That's probably a little loosey-goosey. You're probably going to have to use more formal time and effort reports to document the time that you split between two funding sources. I don't know what TEA is going to do because, last year they revamped all of that alternative time and effort documentation that you do online, and you sign that certification every year. I don't know what they're going to do with that, or if that's actually going to comply with the uniform grant guidance, but it's just warning you what we have to do as far as internal controls are concerned. So here's a little bit more. It has to be supported by a system of internal control which provides reasonable assurance that the charges are accurate, allowable, and properly allocated. So how are you going to get there? Again, semi-annual certifications probably won't do that because you probably have to bring in a job description bring in other documentation that proves that that person is truly an IDOE person. Okay, and then the key is comply with established accounting policies and practices of the non-federal entity. If you've received a desk review letter before, or a site visit letter, you know that the first thing on that request list is your documentation or your policies and procedures documented, not verbal. We don't want to have a conversation. They need that in writing. So that's going to be the key thing. And so they're wanting us to audit based on your documented policies and procedures. Got 5 minutes, people. So I'm going to try to get us through this. But this is the key thing that I think will cause a lot of question costs. Support the distribution of the employee's salary or wages among specific activities or cost principles if the employee works on more than one federal award. The key thing too is don't just go off of budgeted amounts. We always, some entities will say, I think it's going to be 40-60, 40 Title I, 60 General Fund. I think that's what's going to happen. That's fine for internal accounting purposes, but you have to go back and look at the actual record. So why just not do it based on actual? Because you're going to have to reconcile those records on a monthly, quarterly basis. Okay, also, best example for this is Head Start. That has a local match. Okay, employees whose salaries are used to meet a match or cost sharing requirement must also maintain documentation of the time they spent. Okay, so they may be funded out of the general fund, but if you're using their salaries to meet a Head Start matching requirement, you're going to have to show that, obviously, yes, they're working in Head Start and being paid out of the general fund. That's their contribution to the Head Start program. Same thing with, it's similar to the in-kind contributions that are coming from the outside. This is the same thing with the general fund. You have a general fund employee working in Head Start, but you're using that for the local match. They too have to prepare that documentation. So if you have Head Start, I would go back and make sure that that's in place. Already talked about budget estimates are not allowed. That's good timing because it gets into the audit requirements. And all I will tell you, let me get to the good stuff, the numbers. Okay. $750,000 is the threshold that we're using now. So if you don't spend more than $750,000, you're not subject to a single audit. Right now, if you spend more than $500,000, then you are subject to that. The type A/B thresholds basically are telling us what's a large program. If it's a large program, greater than $750,000, then we probably will have to test it every 3 years. Type B programs means that you don't always have to test them. It's just based on a risk assessment. So just know that has changed as well. Other thing to note is question cost. Right now, if there's any compliance issue or question cost that we come up with in excess of $10,000, we're required to report it. Well, that threshold went up to $25,000. Doesn't mean let's get crazy with it, right? But it just means we don't have to report it. Anything under $25,000 is okay. So that's good. That's somewhat good. I wish it were bigger, but $25,000 is what they chose. So I think the big question, and that was a very good question that was asked on the changes to your NOGAs with a new award date, is a good question to say, okay, did they just change the grant guidance for that? So once I get an answer, like I said, from TVA, I'll forward that to Jesus and he can send it to the group. I know I kind of rushed through it, y'all are falling asleep, but it is 2 to 1. Any questions? You can email me. My email is in the back, and I can gather all the questions and send them to TVA. But thank you all.